At the IMF, we have been working on these important issues for decades, for slightly more than 50 years. And just last week, we released an important blog on fixing the great distortion, how to undo the debt bias on taxation, from my colleagues Ruud de Moy, Mick Keane, and Alex Tiemann. And Mick is hiding someplace, as always. Look, even Mick can be unpredictable at times. This blog advertises important research and links up to a couple of new papers that were released at the exact same time. And time is indeed opportune for serious exploration of the possibilities to improve US international corporate income tax regime. For us at the IMF, the interaction of that regime with those of other 188 members is particularly salient, and thus this event will focus in part on those issues of international taxation. The US, as the largest advanced economy in the world and the largest source of foreign direct investment, plays an absolute leading role in international tax. It will not come as new to most of this audience if I say that the world's international taxation regime and that of the US within that is no longer fit for purpose. This is hardly surprising, given that the system grew up in the 1920s when almost all trade was in physical goods and commodities, when almost all of trade was in physical goods and commodities, when intangibles were just a few, and they tended to stay put right in place. And when steam was still a major determinant of the speed of interaction. And the system was conceived among partner countries on the basis that countries were sometimes the recipient of investment and sometimes provide that investment. For our economically less advanced member countries today, that last point is a critical one, as many of the lowest income countries, of course, are essentially only capital importers. And for them, the premise underlying the system as presently designed of bilateral flows and mutual treaties can be both irrelevant and, at worst, damaging. Nor in the 1920s, I dare say, would the phrase conduit country have had the familiar ring that does for most of those here in this room. So, what is to be done? The conference gravitates around three contributions. First, Thornton Matheson of our tax policy staff will present a paper that was prepared last spring in the context of the IMF annual macroeconomic surveillance for the United States. The paper looks at one possible approach to US reform and addresses the potential fiscal spillovers from policy changes within the US regime to other countries. As an aside, much FAD's work on tax policy has always taken place in the context of our confidential technical assistance advice to our member countries, and in that context remains well below the radar screen. The fact that such analysis is now being explicitly set out in greater detail in the fund's macro surveillance work recognizes, on the one hand, the great significance of international tax issues to many of our member countries, and on the other hand, the potential benefit to bring our staff deep expertise in the area, particularly in spillover, more broadly into the global policy debate. Second, Bob Stack and Barbara Angus will lay out two possible approaches to U.S. international reform from either end of Pennsylvania Avenue. And finally, Mike Devereaux of Oxford will discuss possibilities for more fundamental reform to the international tax system as a whole. And we will also benefit from reflections from Mick Keane, that I already referred to, who is a deputy director in FAD. We very much hope that this morning will provide food for thought and ideally considered action. With that, I turn over to you, Kevin, to welcome and moderate the panel. Thank you.
Thank you, Vitor. It's really a great honor to have the director of the Fiscal Affairs Department of the IMF here in these hallowed halls, and welcome, if you haven't been here before, to our new building. It's really great to see you all here. I've been working on international tax since I was in grad school, which means that I've known Mick Keane for a long, long time. And it seems like this might be the first time that we've collaborated on a conference, but it's really long overdue. We've got a heck of a lot to talk about, and I think it's all possibly a lot more relevant than we expected, in the sense that it seems like there's going to be, a good chance that there's legislation coming soon in the United States, and there are a heck of a lot of important things for us to talk about. This first panel, we've got Ed Kleinberg, who's the Ividell and Theodore Johnson Professor of Law and Business at the University of Southern California's Gould School of Law. And Ed is going to lead us off with a discussion of U.S. corporate income tax reform and its spillovers. After Ed goes, then a senior economist from the IMF, Thornton Matheson, is going to talk a little bit about what we know about the econometrics of how this stuff works. And then we'll open up for general conversation. Sometime around 10:30, we'll take a pause and go out and get some croissants and coffee, and then we'll start again after that and talk about some of the specific plans that have been going on in Washington. And again, at the end of the session, we're going to get the view from Oxford. And so with that, I'll kick it off to Ed. I believe that we've negotiated you're going first.
I lost the negotiation. So, first, I'd like to begin by thanking the IMF and the AEI for this opportunity to be here. I feel privileged to be on this panel.
I forgot to introduce
Second, I'd like to congratulate AEI on this extraordinary new space into which it's moved quite recently. It sort of reminds me, I guess, of what God would have done if he had the money. And third, the fund has about 2,500 employees. And I received emails from about 2,375 of them last night, reminding me to begin my remarks with the observation, as if you needed to be told so, that I am not an employee of the fund. I do not speak for the fund, and the fund eagerly disavows most everything that I say. What I thought that I would do is give a little bit of an outline of the paper to which Kevin referred, that Thornton was the lead author of. I worked with Thornton. Kim Klausing of Reed College worked with Thornton, and Kim is not here today, but was the driver of most of the quantitative work in the paper. I think you can summarize the paper as making three big points. The first, which I hope is not terribly controversial, is that the current U.S. corporate tax is highly inefficient. It distorts allocative decisions, where to invest, between which industry, and so on, in ways that are real, even in a fashion that has, I think, a bipartisan consensus. Second, that because the current system is so highly distortive, incremental reform, which we sometimes dismiss as not sufficiently brave, incremental reform can actually do a lot to make things better because we know we couldn't make things much worse. And finally, fundamental reform could make things better still. So let me begin by taking those thoughts and going through them. The current tax system. Let's begin by focusing on the domestic side of things. I think there are three obvious issues identified in the paper with which we have to begin. The statutory rate of the United States is now out of line with the statutory rate of other major developed economies around the world. The average effective rate collected by the United States from the corporate sector are not necessarily terribly out of line. But any time that you see a very wide disparity between a statutory rate on the one hand and average effective rates on the other, that tells you that a great deal of mischief is going on and that a lot of allocative distortions are embedded in the system. Second, because of this phenomenon, we have a substantial number of tax preferences. The government runs in essentially ersatz Soviet-style 5-year plans through the tax code in the form of tax expenditures. Accelerated and bonus depreciation are chief among those in the domestic context, if we take seriously that this should be an income tax. And finally, we have the pervasive and pernicious consequences of the debt bias embedded in the tax system. And we have a country and a tax system with essentially, for all practical purposes, no cap on the total amount of debt, the total amount of leverage a firm can take on, or the total interest expense. And of course, the other side, the income side, is often held by tax exempts. This leads, as Ruud de Muge's work has demonstrated, not just to huge revenue loss, but also to a more fragile economic system. Because leverage, if you live by the sword, you die by the sword at times of recession. And all of this takes place against the background of the third largest unincorporated sector among the countries studied by the IMF. Germany is first, and there's a special prize that Kevin will award to anyone who knows which the second is. It's Austria. Let's talk about rates for a moment. The usual formulation that economists have taught me is that the average effective tax rate determines the location of investment, and the effective marginal tax rate determines the size of that investment. Domestically, that summary is distorted when it comes to the corporate sector by the fact that the unincorporated sector in the United States is so large. And indeed, the way to understand the unincorporated versus the corporate sector is that for any firm organized in the last 30 years or so and going forward, it's really a private versus public distinction. So private firms, if they're rational, are typically in pass-through form, and public ones of necessity are in the corporate form. So the corporate tax is a tax on public companies, which means it's really a tax on a few hundred large business enterprises. When you think about things from the point of view of inbound investment to the United States, I just want to get this point out of the way, because we spend way too much time talking about outbound foreign direct investment, and we forget that the United States of America also is a place where we would like to see investment. So inbound investment is terribly important. My sort of starting point, I think the paper reflects the idea that multinational enterprises generally are in business as platforms to capture global rents. And what would follow from that is that the statutory rate is terribly important to inbound investment into the United States because rents are taxed at the statutory rate. But that in turn overlooks, as the paper points out, the effect of earnings stripping. And so we have this odd intersection of the debt bias on the one hand against the nominally high statutory rate, so that one would expect inbound investment to be disadvantaged by virtue of the fact that rents would be taxed at a high rate. But in turn, because of the extraordinarily lax earnings stripping rules that we have in the United States, subject to the 385 regulations, were they to come into force, means that, in fact, foreign-based multinationals end up being privileged over wholly domestic firms because they can strip so much out of the US tax base and end up with it being taxed at lower rates. examples of the kinds of distortions and spillovers that are not obvious from a superficial glance at the rate structure. When it comes to the second of my points on the domestic side about the preferences in tax expenditures, those, as the paper reminds us, and great work has been done by Treasury, by CBO, lead to different effective marginal tax rates across industries and across firms competing with each other. We have accelerated and bonus depreciation. We have special tax expenditures for different industries. We have the Section 199 domestic activities deduction. We have the R&D credit as well as the expensing. And the R&D credit, in turn, was recently made permanent, which is an unequivocally good thing, but that was, by virtue of the process, was not the occasion to rewrite it, to modernize it, to improve it, which was an unequivocally bad thing. And finally, the debt bias. And the debt bias cannot be overstated. It turbocharges all the other distortions in the system, as the example of the inbound investment just gave. The Treasury, for example, concludes that the average firm level effective marginal tax rate on equity investments is 27%, but on debt finance investments, it's minus 39%. A negative tax rate, that is the after-tax rate of return, is much higher than the pre-tax rate of return by virtue of the combination of accelerated depreciation and the debt bias. The debt equity distortion is, in my view, the tax original sin, and it has to be viewed as an important part of any reform proposal. Finally, we turn to everybody's favorite topic, which is U.S. outbound foreign direct investment. And let me begin with a little homily, and I will say, and as the paper says in a more nuanced way, that it is just plain irresponsible today to write that the U.S. employs a worldwide tax system. It is not true. It is not true as a cash tax matter. It is not true as a financial accounting matter, which is the perspective from which investors and other stakeholders view a firm, and it's not true as a cash flow matter. Looking at the cash tax side of things, the data are overwhelming that demonstrate the derisively low tax rates paid by U.S. multinationals in respect of their offshore investment. You can see it if you want in the Apple state aid case. If you strip out your views about the use of that instrument and look simply at the numbers, the aggregate European tax burden on Apple in respect of all of its European activities is on the order of 2%. You can see it if you just, by inspection, look at the Microsoft financials, because they are very candid and give you the data to compute the foreign effective tax rate by looking at what their repatriation tax cost would be, and that's on the order of 4%. You can see it in the data that Kim Klausing developed for this paper that we're discussing. 58% of CFC earnings are taxed at below 5%. And 77% of CFC earnings are taxed at below 15%. You can see it in IRS data. You can see it in Jane Gravel's work. And you can see it most visibly in the $2.6 trillion of offshore profits, low tax profits, held by US multinationals. It is also true as a financial accounting matter, because for financial accounting purposes, the firms can effectively ignore the existence of any contingent inchoate U.S. tax cost on repatriating funds. They do not have, in general, a provision for such taxes. There are a handful of exceptions. And that means that as far as stakeholders are concerned, there is no repatriation tax, because it's invisible on the face of the return, face of the financial statements. And finally, it is not a constraint to repatriation. When I testified before the House Ways and Means Committee early in 2016, I gave a long example, but the long and the short of it is any firm that wants to repatriate tax-free just borrows in the United States. And it is not true that the firms that we're talking about are under any meaningful borrowing constraints. We're talking about, again, a few dozen firms that account for the great bulk of the offshore earnings. So, multinational firms generally, whether US-based or foreign-based, are platforms to capture global rents from the exploitation of their core intangibles. Jason Furman and Peter Orszag have a good paper on this. Robin Bodway has, I think, a great term. He refers to the modern economy as a rent-rich economy. But economic rents, supersized returns beyond the normal return, come in three flavors, and it's important to distinguish them. There are real rents. Microsoft, for example. Microsoft develops Microsoft Office. It becomes a world-dominating productivity suite. And then somebody says, you know what? We should translate it to Portuguese. Well, they're going to capture rents on the Portuguese extension of Microsoft Office. And it's all, of course, driven by the central importance of intangible assets. And those are real and genuine economic rents. The second bucket are what I think of as tax accounting rents. And those are the tax-created intangibles that are created for the purpose of separating from the ordinary course business activities of a US-based multinational some intangible asset for the purpose of engaging in stateless income planning, moving income from high-tax foreign countries to low-tax foreign countries. Starbucks, you may think that when you go to Starbucks, you are buying a cup of coffee. This is not true in Starbucks' view. You are participating in the Starbucks experience. It is a separate, identifiable, intangible asset held separately from the operation of its stores. And what's more, the secret recipe for burning coffee beans as the roaster is also a separate intangible asset. These are accounting rents. They exist only for purposes of tax planning. And finally, there are tax rents. I've had a lot of good success with my stateless income papers, frankly, but I was always disappointed that this theme was not picked up more. One of my many failings is that I'm very naive, and I believe most everything Mike Devereux tells me. And therefore, I begin from the point of view that because we have open markets across the world, in general, after-tax returns to investment are equalized around the world. If that's true, and we have different tax rates on business around the world, it follows that pre-tax returns in high-tax countries must be higher to yield the same after-tax returns demanded by global investors. The problem is that stateless income planning enables US firms to capture high-tax country, high returns before tax and move them to low-tax countries, and in doing so capture what I call tax rents, a profit attributable to stripping income from Germany, moving it via Ireland to Bermuda, paying no tax, and by doing so capturing the high tax pre-tax returns as after-tax returns. So US firms have extraordinarily low tax rates on cash tax rates, and these are the reasons why in respect to their foreign direct investment. Intangibles drive everything. And in turn, and recognizing that the IMF is best friends with the OECD and don't want to create any friction, and the remarks are entirely mine, it is because of the unstable norms, the international tax consensus, which has been shepherded by the OECD for so many decades. We treat subsidiaries as independent entities. We treat them as having their own brains. We treat them as having their own sources of capital as opposed to just being the receptacles for their parent company. And the BEPS project changes very little in that. If you take the BEPS project seriously, what we are now to expect is that Apple Ireland will say to Cupertino, you know, that Apple Watch sounds like a terrible idea, and we will not participate in that cost-sharing agreement that you have in mind for the Apple Watch. I do not believe that that is a useful principle on which to base international tax regimes. So I am, speaking personally, I think that country-by-country reporting is a fantastic thing, but I don't believe that the BEPS project will, by itself, can succeed in the fundamental problem of pinning down returns to intangibles to jurisdictions in where the value is created or the consumer is located, or both, depending on your point of view of what creates value for an intangible. The result is that we need to think about new norms. And that brings us to solutions. Now, let me talk about incremental reform first. Here, I'm, in a sense, trying to give you sort of a summary of the paper. The paper sort of posits, because it was written in spring of 2016, an incremental reform that would look like a negotiated compromise between the work of Dave Camp, the former chairman of the Ways and Means Committee in 2014, and the Treasury and White House proposals of early 2016 as a incremental reform. And again, just because it's incremental doesn't mean it's pointless. The current system is such a mess for the reasons that I've said that an incremental reform along those lines could have big payoffs. And in turn, it could serve as a stepping stone to more fundamental reform along the lines that the paper discussed, or along the lines that Mike Devereux will discuss later. Key ideas: 25 to 28% tax rate. There's no reason, as the paper points out, to go materially lower. The United States is not a small, open economy, and we make a mistake to model it as such. It has a privileged position as one of the world's largest internal markets. And as the paper points out, still materially lower rates exacerbate a tax competition in ways that are unhealthy for smaller countries. Major base broadening, get depreciation closer to economic depreciation, eliminate most industry preferences, recognize that we don't care about pass-throughs as such, or should not care about pass-throughs as such, but rather that what we should care about is small business, and have targeted small business preferences to fix the research and development credit, get rid of expensing, improve, rationalize, modernize the credit, more robust earnings stripping rules, and then more generally, a domestic thin cap rule. Because without that domestic thin cap rule, the debt bias remains unrestrained. On the international side, the incremental proposal is to replace today's toothless quasi-territorial system that we have with a genuine territorial system, but one that is robust to gaming. And the solution, and frankly, I believe the only solution, if you go with the traditional incremental reform, is a country-by-country minimum tax. I spent 30 years as a tax lawyer, advising in the private sector. I don't believe any other solution is robust to gaming. A country-by-country minimum tax in the form of a rent tax, so that normal returns, which are not the problem, are exempted, and instead supersized returns are subject to a 15% US minimum tax if that is greater than the tax paid in a particular country. The empirical analysis that Thornton will talk about demonstrates that a country-by-country minimum tax along those lines would be effective in slowing down the stateless income game and slowing down the shifting of profits to the ultra-low tax jurisdictions, which is a good thing. The rent tax structure, in turn, is a great first step towards more fundamental reform, which I'll get to in a second, where the paper recommends rent tax as the norm for the business tax system. And it's consistent with the idea that what we really care about when we think about the global work of international firms, of US-based multinational firms, is getting rents. The paper proposes to tax unrepatriated earnings at a 25% rate. This is somewhat higher, for example, than the House Republican proposal, which is 3.5%. So there's room to talk. But the fact is that a tax on unrepatriated earnings, the 2.6 trillion, is an efficient tax. It relates entirely to the past because it is simply the price that is paid for migrating to a new, better system. And because it's an efficient tax, there's no reason to make the number particularly low. And we would revise the definition of corporate residence and tighten the inversion rules. This would still be a residence-based tax in the sense that being a U.S. firm would subject you to these rules. Being a non-U.S. firm would not. The paper argues, and I would argue more strenuously, that the idea that corporate residence is entirely optional is just belied by the facts. No one is confused, except for the tax law. No one is confused that Mylan, sitting in Minneapolis, Minnesota, is an American company. Only the tax law is confused by this. And in general, it is not very difficult to come up with residence rules that follow the commercial norms by which firms identify themselves as U.S. or not. Fundamental reform, now we're shifting gears a little bit, and the fundamental reform proposal is to look to repositioning the corporate or business income tax more generally as a rent tax, so that normal returns would not be taxed at the firm level. Mike Devereux's destination-based cash flow tax does the same thing. And the idea that what that means is you get rid of interest deductibility as such, you eliminate the debt bias in one way or another, and you have all firms facing an effective marginal tax rate of 0 on their marginal investment. It eliminates debt distortions, it gives a consistent tax rate across enterprises, and as such is a much happier place from which to base a business tax system. However, it is important to understand that a business tax, a rent tax, does not mean that the system as a whole can't be an income tax. And I think, frankly, from my point of view as an outsider, a lot of the literature talks a lot about, oh, we want to move to a rent tax, we want to move to a consumption tax, without asking the larger question, are we talking about the firm or are we talking about the system as a whole? And I have 2 enormous, tedious papers, one of which is on SSRN, talking about this. We can have both if we choose to. How do you handle it?
Could you start to get close to the end so that we have time for Thornton and Eric?
Yeah, sorry.
Yeah.
Internationally, we take a different point of view than the destination-based cash flow tax, and we sort of continue to rely on the residence-based system. But again, what's most important is the idea that a rent tax, whether it's called a cash flow tax, or relies on other mechanisms described in the paper, is the direction that fundamental reform should go, provided that we understand that that doesn't mean that the system as a whole gives up taxing capital income.
Thanks a lot, Ed. And before I hand it off to Thornton, I would be remiss not to introduce my good friend, Eric Toder. Eric is going to discuss the work of Ed and Thornton after Thornton goes over some of the economic details. Eric is an Institute Fellow at the Urban Institute and co-director of the Urban Brookings Tax Policy Center. And I think I first met Eric when you were Deputy Assistant Secretary of Treasury a long time ago.
I think I met you before that.
Maybe that's possible.
Anyway,
but Thornton, now it's back to you.
Okay, well, thank you very much, Ed, for giving the sweeping overview of the paper. You were very kind to describe me as the lead author. I was more, I think, sort of what you call a master distiller in your stateless income papers. I sort of took Ed and Kim's substantive inputs and blended them optimally, but Ed and Kim were the true yeast. And I think I'm going to stand up because I can't see the screen very well. But Ed, having given the sweeping view, I now have the much narrower task of presenting the empirical analysis, which was largely provided by Kim, who could not be with us today. So what we did in the empirical analysis is took the incremental reform that Ed just described to you, and using the methodology of Clausing's National Tax Journal article, which will be forthcoming in December 2016, which estimates the US revenue loss due to cross-border profit shifting in the CIT. We took this same methodology and used it to measure what is the impact of an incremental tax reform on foreign company tax bases. And we had to make a few simplifying assumptions in order to do that. But we came out with some interesting results. So again, the parameters of the incremental reform that we're looking at are an effective CIT rate of 25%. Kim's paper uses an initial presumed effective tax rate, not of 35%, which is of course the US statutory rate, but of 30%. So although there's a 10-point cut in the statutory tax rate, we reduce this to a 5% cut in the effective tax rate because the incremental reform is including some substantial base broadening. And we assume a foreign minimum tax rate of 15% with teeth. Although the incremental reform proposes this as a rent tax, for the sake of simplicity, we're just making it an income tax, an effective tax rate of 15%. Again, as in Kim's 2016 paper, the analysis uses bilateral BEA data on US outbound investment from 1983 to 2013. And this is not micro data, just to be clear. It is bilateral data, so the data are aggregated at the country level, and this is just for outbound investment. The BEA also publishes data on inbound investment, but there's not sufficient information there to generalize the analysis to that. So when you look at this data, you see immediately that the bulk of US foreign earnings derive from low tax jurisdictions. Almost 3/4 of US foreign earnings of US multinationals comes from countries with effective tax rates of 15 or less %. And this is robust to different measures of US foreign earnings. We have the BEA has the two different measures, the direct investment earnings and the foreign gross income. The foreign gross income has a bit of double counting, and the direct investment does not have the double counting of some income, but it is less complete. So for most of the analysis, we're using the gross income, which is more complete. But as you can see, these numbers are extremely similar to these numbers. So there's not a lot of difference between the results that you get. And the first step of the analysis then is to estimate an average semi-elasticity of gross earnings of income reported in different jurisdictions to the effective tax rate of those jurisdictions. We do both pooled and fixed effects regressions. And the average effective tax rate, there's a set of other controls, GDP, GDP per capita, geographic distance, property, plant, and equipment, and employment for each jurisdiction. And the average, as you can see, these are all highly significant. The average effective tax rates across all of these different regressions is about negative 2.9%. This is very consistent with what is found in the large empirical literature on the sensitivity of income to tax rates. In particular, Des Moines and Aderveen, 2008, they come up with a result, review of the literature, come up with an average result of about negative 0.3. By contrast, we find that real factors, employment, sales, and property, plant, and equipment, are much less responsive than financials, assets and gross income, to foreign tax rates. This is also consistent with what is seen in the literature. And this would indicate that although there would likely be significant income shifting, reallocation of profits of the corporate tax base in response to a significant change in the US rate, we expect much less effect on the migration of real factors between jurisdictions. So then we get to the methodology for calculating the cross-border income recalculation. And there are two steps here. So using the semi-elasticity of 2.9, we estimate the response of US foreign multinational earnings to, again, the reduction of the effective tax rate from 30 to 25%, and also the, any tax rate that is below 15% gets increased to that 15%. So we're assuming a strong minimum tax rate. And this direct effect reduces all foreign country tax bases. In other words, you're going to get a shift back into the U.S. And the results is particularly dramatic for countries with effective tax rates below 15%, which we refer to generally as minimum tax countries. The average loss of tax base for non-minimum tax countries was about 15% of the pre-reform U.S. tax base, but the average loss for minimum tax countries was as much as 40% on average. And then we have an indirect effect. Allocate, and here we needed to make some sort of simplifying assumptions that are somewhat ad hoc, but I think reasonable in light of the data that we had to work with. So first we allocate back to, you've got all of this income that's sort of been coughed up by the US tax reform. Where does it go? So we allocate back to the U.S. a share of total displaced earnings equal to the share of transactions with U.S. parent to the share to the totality of total affiliate transactions, and this is just a little under 40%. Go back to the U.S. And then the remaining displaced earnings are allocated among all other non-minimum tax countries based on their share of total foreign affiliate activity. So this is a weighted average of sales, employment, and employee compensation. Again, this may seem rather ad hoc or arbitrary, but there is research showing that shifting income is not costless. For example, Grubert and Altschuler have some very nice articles estimating the costs of shifting income across borders. So it's reasonable to assume that the income will go back to the places where there's real activity. And the average US MNE earnings tax base gain for non-minimum tax countries from this indirect effect is 47%, which outweighs the direct effects of the US CIT reform. So when you put when you put together the direct effects and the indirect effects, you see that all non-minimum tax countries there actually gain about 30% in terms of their US tax base. And this is slightly higher for OECD countries versus non-OECD countries, but really there's not a lot of difference there. This is just the top 10 list of the countries with the largest income gains in dollar and percentage term that's the two left-hand columns, and the largest income losses are the two on the two right-hand columns. As you can see, the countries in the left two columns tend to be large countries with substantial markets, substantial populations, substantial resources, whereas the countries on the in the right two columns tend to be more what we think of as conduit or low-tax countries. And then just areas for future research, plan to sort of cross-pollinate the BEA data set with different measures of different tax measures than effective tax rates, look at marginal tax rates and statutory tax rates to try and refine the estimate of reaction of different types of foreign investment to the relevant tax rates. And also, of course, the analysis done in this paper does not allow foreign countries to react to the U.S. rate cut. And there are several articles that show that there would be a significant reaction. So a further paper will incorporate that.
Thank you very much, Thornton. Eric,
Okay, do I
can
have
we
a...
load Eric's presentation?
Oh,
I guess I'll need a clicker here. This makes it go forward and back, is that it?
Hmm?
This makes it go forward and back?
yeah,
I'll figure
it
out.
should.
I think they have to put this up.
But it's not there.
Can you click forward?
Are we getting Eric Toder's? Excuse me?
Click right.
Try it again.
All right, there we go.
There we go.
All right,
Excellent.
okay.
Thank you.
So I'm Eric Toder. Thank you for the introduction, Kevin, and thank you, IMF and AEI, for having me at this conference. I'll make the usual disclaimer. I'm not speaking for the Urban Institute or the Tax Policy Center. I'm also not speaking for IMF, and I'm definitely not speaking for AEI, so we're all understood on that. I think my job is probably to, if Ed and Thornton got you a little confused, my job is to get you even more confused, and maybe to tee up for the discussion. So I'll start with a quote from an economist who is much admired in this building, Milton Friedman, who used to say, there's no such thing, there ain't no such thing as a free lunch. I guess I would phrase that a little differently by saying, there's no such thing as a perfect corporate tax reform. And the reason is that the corporate system today is full of distortions, but every corporate tax reform that I've ever seen leaves some distortion in place and reduces others. So it's really a question of which distortion do you think is the most damaging? So what I want to do is kind of go through two slides which give, well, there's three, but two basic pictures which talk about the various choices we have in corporate taxation and how these authors come down, or which side they come down on these choices. So the first is the issue of where is the international income of corporations or global income of corporations going to be taxed? And we have this standard 2x2 matrix. You can look at the income does it come from U.S. resident or foreign resident multinationals, or is it originate in the U.S., or is it originate overseas? So we have various paradigms. There's the global system where the first, the two left boxes and the top right box are taxed, that we tax on an accrual basis. By the way, nobody has such a system, but we tax on an accrual basis the foreign income of U.S. multinationals. But notice what's exempt is the foreign resident income of foreign multinationals. That's outside the scope of the U.S. tax system. So what the distortion, this system is neutral as to where U.S. companies invest, but it's not neutral as to where foreign companies invest. We can't impose that. And it's not neutral with respect to how foreign and U.S. resident companies are treated, because foreign resident companies are exempt on foreign source income from U.S. tax, and U.S. companies are taxed. So now we move to the territorial system, which is, by the way, one which does not characterize our current system either. In that case, all the income originating in the U.S. would be taxed, and the foreign income of U.S. companies is exempt. So that, in theory, treats U.S. and foreign multinationals equally, but it favors U.S. companies investing overseas, and actually foreign companies investing overseas. So that's going to be true under both systems. So it maintains those distortions. There's a third system, which you'll hear about in the next session, the destination-based tax, and that's kind of a different animal, because actually that is neutral according to the picture in this chart. U.S. source income is taxed unless the goods that are produced by it are exported, and that would be true whether the company generating it is a U.S.-based or a foreign-based company. And the same is true with the difference between U.S. and foreign source income. It's basically always taxed if imported, but exempt if exported. So there's really no incentive either for U.S. companies to generate income overseas, or for U.S. companies to, for foreign companies to have an advantage relative to U.S. companies. Finally, there's current law, which is a complicated mix. It is not a global system because we only tax the foreign income, as Ed points out, when it's repatriated, and some of it doesn't get repatriated for a very long time. And it is not really a territorial system either, because as Ed also points out, foreign resident companies have the ability, which U.S. companies don't have, to strip profits out of the U.S. So the theoretical tax on all U.S. source income really isn't one. Now I'll go to the next slide, which is Clausing, Kleinberg, and Matheson's proposal. And in this case, they would have, in their basic proposal, they would have U.S. companies taxed on their domestic income as currently. I mean, there are some modifications, but that's the basic paradigm. The foreign companies would now be better taxed because there would be limits on interest deductions, which would deter income stripping. You still have the exemption in the bottom right corner. You can't do anything about that with a residence or source-based system. But the foreign source income is taxed as accrued. They would lower the corporate rate to 25%, but have a worldwide tax system. So the theory there is obviously, under this system, the distortion between how you treat U.S. and foreign resident multinationals on income earned overseas is less important than the other distortions that you're correcting. I put in parenthesis their second proposal would not have a global tax, but would move in that direction a bit with a minimum tax on supernormal returns, which would replace the repatriation tax, which we currently have. So it might be thought of as a more efficient way of having a partial tax on foreign source income. So now, just to make this a little more complicated, all of this also has to do with all these problems defining the source of income. With transfer pricing, you can shift income around without shifting anything real. Ed has eloquently described this in his papers on stateless income and shown how that gets done, and the data Thornton presents shows that it is being done. So that's clearly a problem. Defining corporate residence is a problem we've seen with the inversions in recent years, that you could shift your residence without much change in anything real going on. There could not also be, there are mergers that are not inversions, where a big company buys a small company. Companies could start up or grow faster as foreign companies than as U.S. companies. So the residence issue is a really real problem, because on our current rules, the resident definition really isn't connected to anything economically real. And finally, just you'll hear more about destination later, but we had a conference on that at TPC this summer, and clearly there are problems with the destination system too. If you want to do a destination-based profits tax, you have a problem with somebody might set up a sales subsidiary in a low-tax country, and so what ends up is getting stripped, the big part of the profits gets stripped up, and all that gets taxed at the destination is the retail margin. And more generally, there are issues, since most of the trade that takes place in intermediate goods, so defining what the foreign sales, where the foreign sales are located, is not necessarily simple. For a cash flow tax, it's a little bit easier because you're not trying to strip out the profit margin, you're using the whole sale. But then you have other issues. How do you deal with the WTO, which probably will not allow border adjustability I'm not a lawyer, but that's what people tell me. And also dealing with a system which is going to generate a lot of losses for some companies that are exporters. And of course, if you can't use the losses, you don't get the benefit of the cash flow tax. So how do you deal with that? I won't discuss that at length. So the second issue here in this sort of terminology is the question of where the tax is imposed. And as economists, we always say, although the public doesn't believe us, corporations don't pay tax. All corporate taxes fall on people. And just looking at the legal statutory requirement, a corporate tax, because interest is deductible and wages are deductible in the corporate tax, what's left is the profits of the equity owners. So the corporate profit tax is really a tax on the profits of shareholders. This is not to say it doesn't get shifted to someone else, but in the first place, it's a tax on the equity earners. So then the question becomes, if you're going to tax corporate shareholders, there are two terminologies here in this slide. One, what forms of return to equity? Is it the normal return that they get, which reflects some time value plus an average risk premium, or is it supernormal returns, which you see with a lot of the IP profits? The other distinction is where you impose the tax. Do you impose the tax at the individual shareholder level, or do you impose it at the corporate level? So Ed has an interesting proposal here. I'll go through all of them. Current law is corporate plus individual, so you have the corporate double tax, but of course you have preferences at the corporate level, and you have reduced rates on capital gains and dividends and deferral of capital gains at the individual level. So it's a double tax, but not a complete double tax. And that's true for both the normal and the supernormal returns to equity, at least as far as the rate structure is concerned. One might argue that the corporate tax on supernormal returns is a little lower because those are easier to shift out. And then there's interest in flow-through businesses, which are taxed only under the individual income tax. On the CKM proposal, they would flip this around. They would make a distinction between the normal and the corporate returns, and the normal returns would be taxed only at the individual level. There would be no tax on the normal returns at the corporate level, but the supernormal returns would be taxed at the corporate level. Now, one might ask in the discussion why they've made that particular choice, and since the supernormal returns are more shiftable than the normal returns, why it isn't done the other way. And I recognize there are complexities of doing it the other way, but I think that's a question that's worth asking. Again, he's keeping the interest in flow-through the same. And then we talk about their more limited reform, and in that case, you would, the normal returns are basically current law, but with lower corporate rate and with international reforms, and the same would be true for supernormal returns. So they're not making a distinction between a normal and supernormal, except to the effect that the foreign tax that they're having is really only on the supernormal returns, I believe, not on the normal returns. Interest income is taxed under current law, and flow-throughs are taxed under current law, but because they're lowering the corporate rate and not an individual rate, they're putting in some expanded preferences for small business. So my final comment is basically a post-election comment. Is corporate return reform possible today? And so I guess I would say generally the way us academics and policy analysts have defined reform is basically how do you improve equity, efficiency, and simplicity, but not talking about changing either the overall level of taxes or the distribution of the tax burden among income groups. So the 1986 reform was in that spirit. It lowered the rate and broadened the tax base for both the individual and corporate taxes. The other options, I think some of us think the 1986 reforms are not really relevant today to try to go in that direction again. But we are thinking of that in a limited way, and also changing the structure of corporate and international taxation, business taxation generally. That seems to be the direction. But they're really all in the same spirit. The people who are discussing various plans are not looking to lower tax burdens generally. They're not looking to change the distribution of the tax burden. They're looking to make the tax system better and simpler and less destructive of economic activity and less distortive. In the current environment, I think it's probably fair to say that given the political powers that have existed, we're probably going to see an easier path toward change, but it's going to be easier because the people in power are going to accept lower tax burdens on corporations and high-income individuals. That probably reflects a view that we should have a smaller government and that we should have a tax system that's less progressive. And the rationale for that is that it may improve economic growth. I'm not saying it will, but that's the rationale, and that's going to be the level of debate. There's one other thing which is not on my slide, but which is not a general characteristic of Republican policies in the past, but does reflect the Trump policies, and that is a view that is rejecting the paradigm that most people in this room probably accept of globalization, and the paradigm in which this paper was based, that having unimpeded capital flows among countries while still protecting the tax base is a good thing. The Trump anti-globalization position seems to think that trade, and I think particularly capital movements, which have increased, maybe are a negative thing, and that's not limited to the Republican Party. Certainly a faction of the Democratic Party has that view as well. So I think you're going to see some things that are different. It's hard to predict where that is, but it sort of casts in some doubt whether the paradigm under which we all have been operating is necessarily the one that's going to be dominant. Thank you.
Thank you very much, Eric. And Ed and Thornton, would you like to respond to Eric at all before I have a few questions for you too before we open up?
No, I think that's great.
Okay. So my first question is there a country somewhere that you think of as managing their international tax system about the way you would like to? Or so is there any precedent for your proposal?
Well, for the incremental reform, I think it's closer to Germany. Germany has thin cap. Germany's a territorial system. So I think that the incremental reform is that Germany would be a good example. For the fundamental reform, we're all in uncharted territory, whether it's the paper's recommendation for rent tax plus a tax on normal returns at the investor level, or whether it's the destination-based cash flow tax that Mike Devreux has worked on for years. I don't know. Well, I do know this. Several countries have effectively a rent tax masquerading as a corporate income tax. And they do that through their ACE systems, through their allowance for corporate equity. So Belgium, Italy, Brazil have all either have or have experimented with what is in economic substance a corporate rent tax that masquerades as a corporate income tax.
Could you describe how it works a little more?
Oh, sure.
Yeah.
I was taking your earlier admonition to heart and trying to be terse. What an ACE does is it looks just like a regular corporate income tax, and interest is deductible, and in addition, you get a notional interest deduction for your equity capital. I think under the standard proposal developed by Mike Devreux many years ago for the IFS at the risk-free government rate. And so the combination of a notional sort of free deduction on equity plus the deduction, actual deduction on your debt means that your normal returns, which are represented by your cost of capital, are not being taxed.
Got it. I kind of wonder, this is for everybody on the
Actually,
panel.
could I
Oh, yeah, sure, of
couple
course, yeah.
Add, although countries don't have a DCE, the incidence of a value-added tax in terms of being a tax really on rents, which is destination-based, is very similar to a DCE. So countries combine their systems with lower corporate taxes and the VAT. So that is at least a partial way to do it, although.
Yeah, but it's not I don't know of a country that's done a substitution of VAT for corporate income tax.
I think the UK, when they raised their VAT, lowered the corporate rate.
But they still have a corporate
but it's
tax.
But they keep a corporate tax.
That's all I'm saying.
Correct.
Yeah, that's all I meant.
The other thing is there was a worldwide system in New Zealand in the late 1980s, enacted as part of their reform. It was abandoned some years later. I think Mike Devereux advised them at one time. I advised them at one time. So that was at least something that was tried. And at some conference, I heard that Brazil had a worldwide tax. I don't know much about it, but
yeah, I don't either. I know they have the ACE.
So I wanted to ask you to speculate about the political economy of it in the U.S. in the sense that really, if you're a firm that has a lot of rents, we might have the best of all systems, right? So we have this high statutory rate that you don't pay. and so you're not at the target of like a revolution because you've got the highest rate. And you can say, hey, look, guys, I got the highest rate. But really, it suggests that corporate tax reform might, political economy-wise, be harder than you might think because the people who normally might benefit. So maybe you guys are going to say, hey, you can't cut the rate because it's going to benefit Apple, but Apple's not paying it. Really, right? And so they pay some, but I kind of wonder what you think about that. So we do kind of have a political equilibrium where there's a high rate they don't pay, and nobody wants to touch it that has lots of rents.
Well, I don't think the public views Apple as paying a high rate. They look at the financial statements and how much taxes they're actually paying. They may not be accurate at the financial statement reflection of actual tax payments. But there have been those reports out there of companies that pay very little tax. So I don't think they're in the position where everybody's saying, oh, they're paying a high rate and not paying tax.
But I think you are right, and
Yes.
lest you think that because I forgot to give the disclaimer that I'm the only person up here whose views actually reflect the IMF, just work there. No, that's not the case either. The views that I presented and will present are solely my own. I'm sorry. Could you prompt me?
Question of whether Apple, some companies have the best.
Do we have the best of all possible worlds?
The high rate.
Yeah, no, thank you. I think you're absolutely right. The high statutory rate in the United States is a bit of a fig leaf.
That's what I'm saying. Yeah.
Corporations are extremely adept at avoiding it, and yet there is a sense that cutting it is just not politically feasible.
Okay.
Even if it were accompanied by base broadening reforms that would actually give it some teeth.
Kevin's question is sort of the consensus view in the tax law community that multinational firms, in fact, have the best of all possible worlds today in respect of their operations from a tax point of view. It's not clear to me whether their CEOs fully understand that because the territorial tax mantra has such power. But there's no question but that they have a fantastic system today. And there's also no question but that for those of you looking to trim your stock portfolios, that their effective tax rates are going to go up regardless of U.S. tax reform because Europe is sick and tired of the games that U.S. multinationals have played. That's what the common consolidated tax base is about. That's what the state aid cases are about. So their tax rate is going to go up outside the United States regardless. And the question is just how much does the U.S. capture of a somewhat higher tax rate. But their overall rate's going to go up.
So I have one more question before we open up for the floor, which is that I was just at a conference a few months ago at the University of Toronto, where there was a bunch of other work that follows up on the work that Parna and I did a long time ago, showing that statutory corporate taxes have a big effect in international regressions on wages. There have been a lot of papers that have found similar effects. There's also a sort of macro time series literature that Mertens at Cornell has got a number of papers in top journals where they're finding if you change these tax rates, actually have a big effect on overall activity. And so, you know, I kind of, it feels like when we're talking about the moving the money around in your paper, it feels like it's not really having an economic effect was part of what Thornton was saying. I kind of wonder if there's a story that's consistent with your results and with, say, the Mertens results and our results that find corporate taxes and wages have really high correlation. Is there like, what's going on? Why is it that we see it in the wages of so Irish workers' wages, or wherever there's a low tax rate, we see it in their wages. We see it in the GDP growth if you look at the VAR results and so on. But we don't see it in the capital stocks. I've also looked at the capital stocks. You don't really see it right in the capital stocks. So what's going on? So is it intangibles? I mean,
well, the driver of the profits is intangibles. What we see in the data, as you say, on the capital side, we don't see movement of real capital. Property, plant, and equipment doesn't go up. Profits go way up. You know, Harry Grubert had a paper years ago that the profitability of Irish subsidiaries of U.S. firms was 3 times greater than the profitability of sister subsidiaries in other European countries. Ireland is a very small open economy, and it's not surprising to me that if you reduce Irish tax rates, that you're going to see that the incidence of the tax on normal returns does fall on labor, so you'll see increased employment there. And the business of servicing the large numbers of US-based multinationals is itself a job creator. It's tax-driven, but it's a job creator. And finally, most sophisticated US multinationals conclude that the more people you have in Ireland, the more facially plausible your transfer pricing case looks. So Apple has 3,000 employees in Ireland. What they don't tell you is what they're doing is sort of low-level assembly of components imported from elsewhere. So those may all be drivers, Kevin, but I've never done any independent research building on your earlier work.
I guess I would also say I'm a little bit skeptical sometimes about claims that the U.S. is a high corporate tax rate country. It's a high corporate tax rate, but in the U.S., as Ed mentioned, other than Germany, has one of the largest pass-through sectors. That's because of our laws that enable that. So if you have a corporation and they're investing in structures and buildings and office buildings and stuff like that, most of those buildings are not owned by the corporation. They're owned by flow-through enterprises and leased by the corporation. And so there's really a lot of what used to be corporate capital, which really is still being used by the corporate sector, which is not facing the corporate income tax rate. And I think that's a fundamental issue that you need to consider when you're looking at what the burden is. And of course, the tax on individuals is a worldwide tax. It's not on individual income. It doesn't depend on where you invest, whether you invest at home or overseas. So it's
That's
not
a good point.
same.
Yeah, I can see that.
Yeah.
Okay, so now we'll open up for questions. If anybody has a question, please raise your hand and wait for a microphone and identify yourself and try to make your statement in the form of a question.
Sergey Kosteyev, Financial University, Moscow, Russia. I have a question about value-added tax. Does it fit into your proposals? In Russia, we have it, and Russian business is not happy about it. Thanks. Value-added tax.
Yeah. Well, why?
So why aren't you proposing a value-added tax?
We actually do, in the paper, propose a value-added tax. We think that, in general, a business tax reform should not necessarily raise revenue, should seek it to be revenue neutral. And to the extent that additional revenue is needed in the U.S., which we anticipate will be the case over the longer term, due to the growth of entitlements, the U.S. should use more efficient tax instruments such as a VAT or a carbon tax. I can say this because these views were actually published as part of the U.S. Article 4 report. So these are the official views of the IMF.
Well, that makes them quite impressive, Mr.
My name is Hank Gutman. I'm one of the few lawyers in the room, I think. So, Ed, I'm listening very carefully to your description of distinguishing between normal rates of return and super rates of return.
Yes, sir.
Now, you and I had the same job. How do we define a normal rate of return and a super rate of return in the statute? How do you do that?
Well, one of the great advantages of the cash flow tax, remember in the basic incremental reform, we don't have to. It only becomes relevant when you move to fundamental reform. And one of the great advantages of the cash flow tax as opposed to an allowance, the capital account allowance system, is that the cash flow tax does it automatically. It says whatever your marginal investment is going to be, we're going to give you a full deduction for that investment that you would otherwise capitalize. That produces a tax benefit. With that tax benefit, you can buy more. This is the model. You can buy more of the same of that marginal investment, which we assume you can do without affecting price, and so on. And when you get through the iterations, you end up being able to buy 1 over 1 minus t of the original investment by virtue of the benefits, tax benefits created, which means that in the end, a cash flow tax has the effect of exempting the marginal return to capital from tax. And so it does it automatically.
But in your proposal, the
allowance for corporate
full-blown proposal, then you're going to distinguish between super returns and
Right,
normal returns.
right. And so
I'm just curious how you define that.
Well, the idea is it's a rate of it would be set annually at Treasuries plus X. X would be a number that would have to be a economy-wide estimate of the risk-adjusted marginal return. And I actually talk about this in more detail because in a follow-on paper that I'm going to put up on SSRN in a few days.
Do you have other questions?
There's something in the
Mr.
back.
Brill, and then we'll finish up here in the front.
Thanks. Alex Brill here at AEI. Thornton, from the tables that you presented, as I understand them, you choose the policy recommendations and then you apply the elasticities to estimate what the changes in the flows in income would be. Could you also work those metrics backwards to try to estimate what tax rates would yield perhaps a similar amount of revenue as the amount of revenue that we have today using those elasticities that you identified in the literature? In other words, why are the rates that you chose for these structures? How do you know that those are from a budget perspective, optimal?
We did not subject those rates. Well, the incremental reform that we propose, we actually suggest a rate between 25 to 28%. We didn't do detailed calculations, although we did look at base revenue estimates for base broadening reforms by Treasury and JCT, and we estimate that a corporate income tax rate of between 25 to 28%, given the base broadening measures that we propose, could be revenue neutral. We didn't crank through the details of an absolutely revenue neutral reform.
Okay, and we've got one last quick question before we take a break for coffee.
Thank you. My name is Li Yang. I just want to ask whether you can tell more information about offshore tax haven.
Where you can find such information?
No.
Is that the question?
Offshore
Yeah.
The tax
haven, and how the U.S. is going to respond, or what new legislation going to be?
That's a great way to finish this off, because the minimum tax is kind of a response to the tax haven data that you guys
Yes.
showed. And
Yes.
so I think that their proposal is a response to the perception that the tax havens are draining revenue from the U.S.
And the White House Treasury proposals in early 2016 have more information about what that minimum tax might look like, and we piggyback off that. So the minimum tax is meant to respond to the tax haven problem that the empirical data reveals in the, as a real problem.
Well, thank you very much for your attention. We'll break now for coffee. Please try to move back in at about 22 so that we can get started right away at 1:15. All right. Well, thank you all for being so prompt. Once again, I'm Kevin Hassett for the American Enterprise Institute, if you just joined us. And in this session, we're going to hear from two of really the top tax experts in town. Barbara Angus is the Chief Tax Counsel for the House Ways and Means Committee. She was previously a principal with Ernst & Young, where she was leader of International Tax Policy Services. So you know something about international tax policy, the topic of the conference. I'm just an economist, so I know about it in models and stuff, but I don't actually do it. Earlier in her career, she served as International Tax Counsel for the Treasury Department, principal with PricewaterhouseCoopers of the Federal Tax Policy Group, and Business Tax Counsel for the Joint Committee on Taxation. She received her bachelor's degree from Dartmouth College, her JD from Harvard Law School, and her MBA from the University of Chicago. It's a kind of nice set of schools. I'm going to insert moderator preference here that Barbara is the Chief Tax Counsel for the House Ways and Means Committee. She's going to talk about a blueprint that came out last summer. The audience, the moderator will frown upon members of the audience who try to tease details that haven't been made public out of Barbara. We won't stand for that, so we're going to talk about the blueprint. And Barbara's going to go first. After Barbara, then we're going to go to Robert Stack. He's the Deputy Assistant Secretary for International Tax Affairs in the U.S. Department of Treasury. He's also the reporting authority for the Office of the International Tax Council, provides advice and counsel to the Assistant Secretary related to international tax policy and tax treaties, and officially represents the administration's interest in international settings, which sounds like it at times must be really fun. You get to go to cool places. Although we have to talk about tax, I guess. And Robert is going to give us, the original design of the session was that we were going to talk about a specific Treasury proposal. I think that he's going to do a little bit of that, but also give us some wisdom should people want to legislate going forward based on his experience over at Treasury. And with that, I'll begin with Barbara. Barbara, thank you so much for joining us.
Terrific. Thank you. It's a pleasure to be here today, and it's a pleasure to be here with Bob and with you. I'll just start with just a small housekeeping note that the views that I'll express are my own, and I'm not speaking officially for the chairman or the committee. With that, when the conference was organized, I was asked to talk about the House blueprint for tax reform. And I'm very happy to be here talking about that. The blueprint was released on June 24th. If anyone is looking for it, I have a dog-eared copy here. And you can find it on waysandmeans.house.gov/tax-reform. And lots of materials on it. So I thought I'd start just by talking a little bit about the background, about how we got to the blueprint, because I think that's really important in looking at the design of the blueprint, and it's also important looking forward. The blueprint builds on the work of the Ways and Means Committee on tax reform over the past 5 years, a very intense process led first by then Chairman Camp and then by then Chairman Ryan, focus on all aspects of tax reform. I think Chairman Camp's tax reform draft really showed that comprehensive tax reform, that a full comprehensive tax reform package was possible. Chairman Brady often says that he believes that Chairman Camp's package also helped to make comprehensive tax reform inevitable. Chairman Ryan continued the focus on both the urgency and the importance of tax reform. And at the beginning of this year, the members of Ways and Means were really eager to continue the work and to expand the dialogue. And I think in that regard, Speaker Ryan's Better Way project, his project focused on 6 key policy areas to get House Republicans looking at and building consensus on ways to improve the lives of Americans in these 6 policy areas, including tax reform. that project really provided a terrific opportunity. It provided a framework and an infrastructure for expanding the dialogue on the details of tax reform, on the challenges of tax reform, and on the urgency of tax reform beyond the committee and with the conference at large. The tax reform task force was unique among the 6 task forces. In all of the other policy areas, there were multiple House committees of jurisdiction. For tax, there is only one House committee of jurisdiction. So the tax reform task force was a task force of 1 with Chairman Brady, the only member of the task force. So maybe because of that task force met more often than any of the other task forces.
In continuous time, in fact.
So we had weekly meetings when the House was in session, and really a terrific dialogue. We looked at and heard from members of Congress that have developed bold proposals for completely overhauling the tax system. We also heard from members of Congress that had developed more targeted proposals within the context of the traditional income tax system. We had a dialogue with economists about the ways in which the tax code designed appropriately could help drive economic growth. And the blueprint really is the culmination of those discussions in the task force and the hard work of the members of the Ways and Means Committee. In looking at sort of the factors that became an important focus, I mean, certainly there are lots of factors that point to the need for tax reform. I think I'll just mention a couple that resonate particularly today and that were an important part of the dialogue leading up to the blueprint. And both are things, they're not new developments. They clearly are developments that are a culmination of lots of occurrences over time. And one is just a clear expression of the public frustration over our current tax system. The American people are fed up. They think the tax system is way too complicated. We're at a point where we've got sort of the average man on the street thinks that everyone else is getting a tax break except him, and that kind of frustration with the system is a real problem with a system like ours that's based on self-reporting and voluntary compliance. It shakes confidence in the fairness of the system. And when you look at the compliance burden, Tax Foundation did some work, came out with numbers earlier this year that estimated that the cost of tax compliance in 2016, Americans will spend over $400 billion and 8.9 billion hours complying with their tax obligations. That's a lot of time and money that could be spent elsewhere. I think you would probably have better ways that more productive uses for that time and money. Another critical factor that was a real focus this year is the changes in the international tax environment and the ways in which they are creating further and more urgent pressure on the current U.S. tax system. We've got the OECD BEPS project, the developments coming out of the BEPS project in countries around the world, sort of the BEPS plus developments as we see multiple countries making changes, sometimes in unison, maybe more often than not in different ways or to different degrees. We've got the EU state aid cases. And while the European Commission and others deny that U.S. companies have been deliberately targeted, I think there's no denying that U.S. companies are in the crosshairs. And the lockout effect that encourages U.S. companies to build up foreign earnings offshore is a significant factor. Other countries don't have systems that put their companies in the same position. So I know, well, I'm hoping that Bob will talk more about developments there, given the really important role that Bob has played in advancing sort of the U.S. concerns in this area. But it really does drive home the need to address the issues that we've long known we needed to address in our international tax system. Chairman Brady often says that tax reform happens only once in a generation. It's one of his favorite lines. It's actually one of my favorite of his lines because it resonates for me in a really personal way. I started in 1986 sitting in Al Warren's corporate tax class, learning about the 1954 code and these ideas that people were talking about in Washington for potentially changing it. I ended that year as a brand new associate in the tax department at a law firm in Chicago in meeting after meeting, learning about all the reforms that were reflected in the 86 Act and what the new 1986 tax code looked like. I remember thinking at the time, having this a sort of sudden feeling that this was a huge advantage for me because no longer did the more senior lawyers in the department, the partners, have an advantage because of they knew the tax law because it was all new. I learned pretty quickly that they still had an advantage. But I'm looking forward to a next generation that experiences that same feeling. Anyway, the fact that tax reform does real big tax reform happens only once in a generation clearly affects how you need to look at what that tax reform should be. And it certainly has affected the views of the members of the Ways and Means Committee. The blueprint reflects the members' commitment to bold reform. Tax reform is difficult, it's complicated, it's disruptive, and it doesn't happen very often. And so to a member, they all concluded they needed, that what we need is bold changes, bold reforms, and reforms that will stand up will last for a generation if they need to. At the same time, I think the blueprint reflects the members' prioritization of reforms that will drive economic growth. They listened to what they heard from the economists, and clearly have a view that the biggest benefit that the tax code can provide is not sort of a particular tax break, but the biggest benefit is helping to grow the economy. So with that sort of background, just sort of an overview of the key elements of the blueprint reforms. Blueprint does contemplate comprehensive reform, so individual reforms, business reforms, and international reforms, and also a restructuring of the IRS. The idea being that we need to better align the tax administrator with this newly restructured tax code. I think it's fair to say that really all elements of the tax reform are very much interrelated. So while I know we've got an international focus today, I'll touch on each of the areas. On the individual side, the reforms are very much driven and informed by what members hear from their constituents all the time is they want a simpler system. And sort of a clearer system, one that they can understand better. So the blueprint provides for lower and flatter rates. It also provides for further reductions in the tax on investment income, capital gains, dividends, and interest in order to drive savings and investment. It eliminates the corporate minimum. It eliminates the individual alternative minimum tax, which requires individuals to calculate their tax twice every year. It eliminates the estate tax, It retains some key provisions that are important for life events, but otherwise contemplates the elimination of special credits and deductions in favor of lower rates and a simpler system for all. On the business side, very much a focus on driving growth in the economy. So a 20% corporate tax rate, a recognition of, in today's economy, the importance of addressing not just the business done through corporate solution, but the huge amount of business that's done today in the United States outside of corporate solution. So provides for a 25% business tax rate for income earned through a pass-through or a sole proprietorship. It provides for immediate and full expensing of investments in tangible and intangible assets. The economists tell us that that is the number one tax provision that can be used to drive growth and encourage investment. It provides for the elimination of deductions on net interest, a provision that often is viewed as going hand in hand with an expensing provision. It provides for carry forward of NOLs with interest for the first time, so NOLs don't lose their value over time, and it eliminates the corporate AMT. On the international side, the blueprint contemplates reforms that I think really are transformational. I'll start with border adjustability. The core tax system reflected in the blueprint is a move toward a cash flow tax, and that allows us to look at border adjustments such as are used by our trading partners. And so the blueprint contemplates an elimination of tax on exports and an elimination of the effective current law subsidy for imports. It also contemplates a territorial system, 100% exemption for dividends brought home from foreign subsidiaries, as many of our trading partners have, and also reforms in the Subpart F area that will move in the direction of making our CFC rules look more like those of other countries, and focus in particular on passive income. As a transition into the new system, the deemed repatriation provision with respect to old earnings that has been included in many of the reform proposals that would move to a territorial system. Really, the bottom line for the international section of the blueprint, and I really shouldn't separate that from the business rules because they're important here as well. The idea is to eliminate tax as an incentive to locate outside the United States. Just a couple of final comments. The blueprint was intended as the beginning of a conversation, and with tax reforms as bold as some of these reforms, we appreciate that feedback is critically important. Since the release of the blueprint, we've gotten lots of valuable input. So the conversation has continued as the committee and the staff have focused on the work of building legislation based on the blueprint. When the blueprint was released in June, the Speaker and the Chairman said that the plan was to be ready to move tax reform legislation in 2017. The Speaker and the Chairman have been clear about their excitement about the opportunities to work with the President-elect and his administration to make pro-growth tax reform a reality in 2017. And as someone who entered the tax profession just as the last big tax reform was being finalized, from a personal perspective, I certainly couldn't be more excited about the opportunity to be a part of the team that contributes to the effort to get tax reform done next year.
Thanks so much, Barbara. And I know that I speak for everybody in the room that it gives us all a calm and peace of mind to know that someone with your experience is in there, getting ready to draft legislation and get the language right. Bob Stack.
Thank you so much. First of all, it's a delight to be here today. It's a perfect time to be looking at the various options that'll be before the country as the next administration moves in. My comments today, really for the first time that I've spoken publicly, are solely my own. I don't come today with U.S. Treasury views on the House proposal, future proposals of a future administration. My job at the Treasury Department in my remaining time is to do the best job possible to create an efficient transition to the new administration, and I'll be focused on that. But I have learned things in my almost 4 years at the Treasury Department that I did want to share, because I think these things will flavor the ongoing debate. We know that there's the House blueprint. We know that the Senate had been working on plans on integration. We know that the incoming president will have some ideas on tax reform. So all of these things will be part of what Barbara described as a conversation, and I just wanted to share today some perspectives on my job that might influence the conversation. First of all, I think I want to re-emphasize something that really came up in the last panel, which is the degree to which in the international tax debate, the mobility of capital, the mobility of income subject to intangible property and rents, and difficulties around questions of residence really are at the heart of issues that have put extraordinary pressure, in the international tax space. And I think for a group like this, I mean, in a sense, that's the headline, and that's what all of these different plans are trying to struggle with, is the interplay of these difficult questions, added on to which, and very closely related, let's say from a U.S. perspective, a pressure for inversions is what, a lot of this game is all about. But going over, I represent the United States in the Organization for Economic Cooperation and Development. I'm the lead delegate there, and I've worked very hard on the base erosion and profit shifting program over the last several years. It's also important for these audiences to appreciate the growing role of the G20 in asking questions about international tax policy and putting policy questions front and center, not just for the US, but for the G20, and also, as I'll talk about in a minute, for developing countries as well. And as the US begins this tax reform debate, I think or continues it, I suppose, what I think we have to be very, very conscious of, and it also came up in the last presentation, is the degree to which US multinationals around the world are viewed as not paying their fair share of taxes. And I don't want to steal from Mick and Mike's next panel, but it is not possible to separate out that fact from what will be happening in the global space going forward. And we need to be asking ourselves, how does that tie back to US international tax reform? The first point I'll make about that, and we saw the statistics for where the income goes into the low tax jurisdictions. And what's really critical for US audiences to appreciate about those statistics is it's not just the lockout effect, the deferral of US tax, that puts the pressure, but it is the fact that the US multinationals, as Ed pointed out, are able to use the international tax structure to strip income from higher tax jurisdictions into lower tax jurisdictions, kind of to a fare thee well, and that has created and will continue to create enormous pressure in the US tax space. Now this adds to extraordinary uncertainty for investors around the world. And the uncertainty comes in many forms. First, there are laws almost every day being proposed by countries around the world that are very concerned about this phenomenon and want to stop it. Second, and really important as this idea of minimum taxes, which may fade away in the future debate, but I want to return to a point because many of these changes we're seeing in countries around the world are what I'll call backdoor minimum taxes. In other words, if you're paying a royalty out of my jurisdiction to a low tax place, we're just going to suck that income back into my country. Or if you're otherwise diverting profits off into low tax countries, we'll pull that income back into a place like the UK. So the concept of minimum taxes, whether they are in part of US policy or part of foreign countries who are upset about the use of tax havens, I believe is going to be in the air and in the future, and I'll turn back to that when I talk about developing countries. Third, not only are countries going to impose laws to pull back this income into their jurisdiction, but second, they are doing so through aggressive audits, lack of appeals, and all sorts of other ways that countries are mobilizing, through which they're mobilizing their ability to protect their revenue. Now to a point that Ed made, with which I think I slightly disagree. It is not at all clear, and I think the study pointed out as well, it is not at all clear that the income stripped into tax havens from the U.S. really belongs in jurisdictions with low-function entities. In fact, Ed kind of contradicted himself because he mentioned the low level of functions that the Irish do in Ireland, yet at the same time he's defended the state aid grabbing $14 billion back into Ireland based on those low functions. So what U.S. policymakers have to be thinking about is the fact that the income comes from the IP structures that the U.S., our development, our R&D, our genius in our companies, and when that's pulled back into other jurisdictions, that is money arguably that the U.S. should be taxing in some way or another. So the foreign piece, the international piece, is not something to be ignored either for U.S. multinationals or for its effects on the U.S. tax base. But let me also go to this issue gets blown up even more when you get to the digital economy, what people call the digital economy. Not only are the rents very high because of the extraordinary technical base on which those companies are built, but if you look at companies like a Facebook or a Google, where at least with Apple and Amazon, you got a package in the mail that was a good that was manufactured somewhere and you can start to work off all normal parameters of international tax. But with advertising and two-sided models, what the foreign countries see are really two things. They see the fact that the company is making buckets of money in their jurisdiction, and two, that it's one of these ubiquitous presence in the world and in their space, and they want to tax some of that income. And so the question I think that U.S. policymakers have to face going forward is do we abandon the foreign space? Do we adopt a U.S. policy? And maybe this is a question for the territorial. Do we abandon the focus of U.S. policy on a system of taxation globally to those forces out in the world that are moving towards a minimum tax, that are seeking to pull back income of U.S. enterprises, which, by the way, in some territorial systems is no longer creditable in the United States. So the United States government would have very little stake in what these other countries may want to tax. So that's a question. It's part of what I'm perceiving going on in the world. I do agree that transfer pricing has been put under extraordinary strain. It's part of the problem of capital and income and residence to a great degree. I also agree that the kind of the paradigm we have of respecting separate entities and contracts is fragile. But the fragility of that is not so much that the concepts themselves, if applied between countries of equal development or equal rates, don't work. The problem is that the constructs have been used to assist in the sucking of that income off into the tax havens that we saw. And what that has done is delegitimized transfer pricing around the world and have made it very difficult to defend, in the many ways that we have to do it. Footnote, and this will sound somewhat defensive, and I suppose I mean it to be, but in the BEPS process, we were not given the opportunity to say, design a brand new global tax system. I like to say we were given that old Model T Ford and said, maybe that carburetor needs a little fixing. Because if you want to walk away in the global system from transfer pricing and separate entities and contracts, you really have to ask yourself what will replace it, and what will replace it that can produce principled results with some certainty. And to me, at least, in the time we had in the BEPS project, that answer was not obvious, and I don't really think it's obvious to anyone. The next point I've made a lot, but it's kind of also in the international space, the very powerful role of the NGOs that are played around the world. So this kind of particularly European fascination with the ideas put out by the NGOs and their adoption is again a phenomenon that I think will continue. We've seen it in country by country reporting. You may think there's a hint of it in the state aid investigations. You're seeing it in various elements of the ATAD, the Anti-Tax Avoidance Directive adopted by the EU. Those forces are very strong in the rest of the world, and I think we can expect those to continue as well. Let me just make a point on, I want to talk, going back to the G20, about the developing country space. And the reason I want to talk about the developing country space is, well, first of all, I'm at something sponsored by my good friends at the IMF who spend a lot of time and have taught me a lot about this space in my time at the Treasury Department. But the big thing in the G20, right, is increasing global growth. And part of increasing global growth for developing countries is something we all call domestic resource mobilization. Now, domestic resource mobilization is in large part, about helping developing countries tax their people, figure out how to reduce the informal economy. You just saw India took a move over the weekend. It's really critical that they can raise the resources to support their economies and they can add to global growth. Why is that important? Well, I don't mean it to be like Mr. Pollyanna, it's a nice thing to do, but if you think about future US markets for goods, having good growing economies around the world is a good thing. And also if you think about global stability, I'm not a defense or a national security guy, but you have to think that growth and economic opportunity around the world is probably better for stability, than its opposite. And so we have an interest in that. And the question of multinational taxation also plays a role. It's not, in my mind, the key role, which it is sometimes made out to be, but it plays a role in helping the developing countries mobilize their resources. And it's critical that that work will continue, again, apart from, side by side with, or integrated into US tax reform. And in that space, you do hear calls for minimum taxes. Why? Because if a multinational wants to strip out of a poor country into Bermuda, they have a different incentive to do so if that income in Bermuda is going to wind up taxed in the United States at some minimum tax level. And indeed, more broadly, you can argue that there's a stabilizing effect of something like a min tax. But more importantly for this audience, the min tax concept is one that is becoming popular among those supporting developing country tax as ways for them to protect their tax base. And the only point I want to leave on this is country by country reporting began in the developing country space as a concept pushed by NGOs. So I think we're going to see these concepts continue, and I think US audiences have to appreciate the fact that there's a whole world out there that debates these issues and has enormous stake in it. I'll just wrap up quickly on a couple of points. In the US, right, so when you bring all this back into the US, we have a set of international issues we care a lot about. One is base erosion, right? So if your US tax rate is something high and the foreign rate is something low, you're going to see different ways that you can erode the base and you need to protect it. And I think to Barbara's point in the blueprint, we should all acknowledge the cash flow tax is, somebody called it earlier, a separate animal. It's very intellectually intriguing in the sense of how it takes some of our long-standing assumptions about the income tax and kind of puts them over here and creates a different debate. And it is, I think, focused on things like its effect on inversions or the effect on transfer pricing. And so it's kind of a welcome addition to a broad debate about what we do. Inversions, of course, has been a big issue for us. And the only point I want to make on inversions, at least in the traditional income tax space, is we will never get to a rate low enough that would say to companies, there's no place in the world I'd rather be headquartered. The other factor in US is leveling the playing field between domestic and foreign companies, which has already been pointed out. The foreigners get the advantages on the earnings strip and things like that. I mentioned the lockout effect, which of course everyone agrees we should do away with. But I want to caveat that the territorial systems that continue to permit US companies to strip into tax havens are going to be as prone to being attacked by things like state aid investigations and foreign countries as would locked out income as well. Two last points. One of the things the economists have taught me is they care a lot about two things. One is distributional effects of tax reform, and second, believe it or not, is revenue. I was surprised to learn when I came to Treasury that one of the things economists actually care about is whether taxes raise the revenue you need to do the things you want to do. And on distributional effects, I was struck by a quote yesterday from a guy named Jeffrey Cabaservice in the New York Times, who's the research director for the Republican Mainstream Partnership. And he wrote, if the Republican Party wants to keep its new working class constituency, it will have to make the economy work for them. The GOP is unlikely to retain these voters if most of the benefits from its tax cuts and other economic policies are seen as going to the party's most affluent supporters. Quote from a Republican, yesterday's New York Times. Another quote yesterday from Thomas Edsel's column quoted a Reuters Ipsos election day survey of 10,604 voters revealed that, quote, 72% agreed that the American economy is rigged to the advantage of the rich and the powerful. So now let's go back to distributional effects. And we know about three things, a lot of economists in here, I assume. Number one, we know that the corporate tax, in fact, it's pointed out in the blueprint that CBO, JCT, and the Treasury Department agree that the corporate income tax falls maybe 25% on labor. That's called conservative, but pick your number. But there's a great deal of that income tax that hits capital, number one. Number two, we know that the capital flows disproportionately to the higher income groups. And number three, we know that the pass-through income also flows disproportionately to the highest income groups. And so when you're hearing S-corps, small businesses, and thinking mom and pop, the distributional data tell you something else. So I would think that as we move forward in tax reform, and given the political environment we find ourselves in, these distributional issues will bubble around or not. But those are things that I think are, in the atmosphere. Finally, on revenue, I'll just simply point out that we are obviously going to enter into a phase, I think even Barbara would agree, that the numbers that are talked about in different proposals, whatever these rates are, there are kind of dials that everybody uses, right? Because at the end of the day, wherever we go, you've got to match the revenue with the expenditures that the government wants to need to do something that's economically sound. And I want to add a point about President Obama and the last several years of tax reform debate. If you take a one-time benefit on, let's say, repatriation, and say, oh, I got in the 10-year budget window, but then you're losing money in years 11 through 20, let's say, on some corporate tax reform, the question really is that really fiscally sound thing to do, notwithstanding it plays within the current way we do budgets? It's a question. I also think that it's really important for everyone to understand that, and I have enormous respect for JCT, CBO, the Treasury, that the professionals in those departments that are going to be tasked with doing the revenue estimating as all these plans turn around are really going to be front and center and very, very important players as we move to the tax policy debate. Most of the economists in the room most economists that I talk to have said dynamic scoring is not going to be the politician's equivalent of the freest of free lunches, which is we can cut everyone's taxes and raise more revenue. And that's going to put that pressure back on our good professional economists in the various sections of government to look into those issues. So with that, I'll conclude.
Yeah, thanks so much, Bob, and thank you also for your service. I kind of, before I open up for questions from the floor, I kind of have this feeling that there's some thoughts that are floating around today that are mutually inconsistent. And so Thornton and I had a conversation that the corporate tax rate in the US is kind of like a fig leaf, that there are all these people who have a high rate but they don't pay it. And yet at the same time we're anxious about the revenue loss if we have a reform. It seems like that those two are kind of inconsistent. The fact is that there's a big literature that Clausing too that looks at revenue responses to changes in rates. And so I don't think, Bob, that thinking about the massive hemorrhage of revenue loss on the corporate side of this is the right way to think about it. The whole point about the multinational tax system is that we've got a high rate, we're not collecting revenue. But the second thought, and this is actually, I asked a response from Bob, is that I have this sense that people think that if there was an Olympics in transfer pricing, that the U.S. would win the gold medal, that U.S. firms. And it could be that that's true, but it could be true because we've got all the intellectual capital, or we have a lot of intellectual capital, or it could be it's true because of our rules. So do you think we'd win the gold medal, and do you think it's because of the current rules, or do you think it might just be because we've got all the rents?
It's a very complicated question. I will say that, let me just say this as a technical matter, right? Our own cost-sharing regulations and check-the-box rules are as much to blame for the ability of U.S. companies to kind of move money into these tax havens as is any particular multinational or the laws of foreign jurisdictions or even transfer pricing, I guess, well, that's not true because of the buy-in payment and the cost share. So whether we'd win it or not, I don't know. I mean, the U.S. may be losing revenue. I want to go back to your first point, though. I don't think you meant to say we don't collect any revenue from the corporate income tax that needs to be replaced, right?
Well, that's not what I said, so I didn't mean to say.
Well, you said we're not collecting it.
So it's a fig leaf. It is a fig leaf. I mean, so the whole point is that you're talking about people being able to move their money around to the low tax place. And when we look at the responsiveness of revenue to changes in the corporate tax rate, we find we're on the wrong side of the Laffer curve. So
I don't know what that means.
it means if you cut the rate, you get more revenue. There's academic literature on this. I'll send you some sites. But I'm just saying that in that space, I understand the rules of the Joint Tax Committee are very important, and but revenue neutrality in front of the Joint Tax Committee is one thing. Thinking about what the economics literature says is another. And right now, to be the high tax place that's not getting revenue, it's like actually the canonical example of what the Laffer curve looks like.
But the blueprint had $4 trillion in corporate tax revenue in the next 10 years. I mean, are we getting that or not?
What do you mean? Are we going to get that revenue? Yeah. Well, the blueprint is a different thing. We're talking about changing the rate.
I'm sorry, but they were quoting CBO. So I mean, so.
All right. Well, I will open up for questions. Yes, right here in the front.
Thank you, Nick Farmer. Could you address the possibility and desirability of eliminating the business tax completely and taxing instead to get the revenue individual shareholders and employees, and maintaining both revenue neutrality and distributional neutrality through whatever changes are necessary in both the individual taxes as well as the business taxes?
You want to take that?
Well, that's an interesting idea. I think parts of that idea are probably reflected in the work that Chairman Hatch and the Senate Finance Committee staff is doing on corporate integration, which is another bold idea for tax reform, focused on many of the same objectives as the blueprint in terms of making the U.S. more competitive, eliminating incentives, eliminating tax-driven incentives to move outside the U.S. Very, very, very different approach in its technical details than the blueprint, but certainly an interesting approach. The two chairmen talk often about the two approaches. And certainly, from a staff perspective, it feels like having more bold ideas out there being seriously discussed and analyzed by the economists at JCT and CBO and Treasury, as well as the economists in this room and elsewhere, is a good thing for the system.
I would just add that at least the economists tell me that the number of taxable individuals that hold shares in U.S. companies is relatively low. And you've got a lot of institutional investors that don't pay tax and foreign investors that don't pay tax on capital gains and have treaty benefits on dividends. And so that the amount of reduction you'd have to do, amount of increase you'd have to do in the individual rate to make up for reductions in the corporate rate is actually quite alarming or shocking or big, whichever word you want.
We have a question right there, and then I'll go back there. I've already had your question. So right here, our friend from Russia.
Yes, Sergei Kosteyev, Financial University, Moscow, Russia. Two very short questions. To Barbara Angus. Do you have a value-added tax in your proposal? And a question to Robert Stack. Did anybody from Trump transition team contacted you about getting some information? I have been reading news that Trump transition team have been really slow in reaching out. Thanks.
I'll answer mine first. No value-added tax in the blueprint.
And I won't comment on anything having to do with the transition. Thank you.
Ed, you want to jump in? Could you wait for the microphone, please? And then I'll go back here.
No, Ed needs a microphone.
Barbara, this is not meant to Ed Kleinbard from USC. I'm not trying to pry under the hood. I understand the rules. But the blueprint does recommend a destination-based cash flow tax with a deduction for domestic wages. And therefore, you all must have thought carefully about the WTO implications. And the simple question is, in the view of the staff and the Ways and Means Committee, is the destination-based cash flow tax WTO compliant? Or instead, do we have a theory about, even before the election, of some renegotiation of WTO understandings?
Certainly, the WTO rules were a focus, as is referenced in the blueprint. We had the opportunity to go in this direction because of the move to a cash flow tax. Destination-based cash flow tax is a case of first impression, but a cash flow tax, the economists will tell us, is a form of, it is a consumption tax. And that falls on a different side of the line of indirect and direct tax than our current income tax. We believe that there is that there is a case to be made here. We also believe it's incredibly important to make that case. In terms of thinking about the WTO issues, certainly something that we're thinking about in all aspects of design of the blueprint, both the design of the mechanics of the border adjustments and also the design of the cash flow elements of the system.
Yeah, and I'm not a lawyer and I don't know anything really about the WTO, but I do know how to write down a budget constraint, and it is mathematically identical to something that's trivially compliant. And so that gives one hope that maybe eventually the lawyers would figure that out. We've got a question or two. Eric, you've got something. And then I have to end after Eric's question. I apologize because Barbara has a very, very tight schedule right now, and I promised I'd
There's going to be a race to who can like first.
Eric.
Okay, it's a question for Barbara. You mentioned simplicity, and one of the characteristics of the House GOP plan and the Trump proposal is a fairly substantial gap between the top tax rate applied to individual income and the pass-through tax rate. So my question is, how do you plan to police that boundary in a way that doesn't create a lot of complexity?
As the blueprint indicates, we certainly recognize that that's an important issue. When you move to a 25% business rate for business tax, you've got to come up with sort of the reasonable compensation component. If you just think about things sort of in a traditional corporate world, the amount that would be paid in wages, we wouldn't use those words in a partnership or pass-through world, but it's the same concept. We have been very focused on designing rules that are intended to accomplish that objective. It's a key element to this system, but it does allow it will allow the treatment of businesses that are not formed as corporations to be more comparable to the treatment of business that's done in a corporation. And for the first time, it will allow sort of small businesses or mid-sized businesses that are done through pass-throughs not to be sort of subject to the top individual rate, which is a rate that wasn't designed for that kind of business income. So certainly really important element of the work we're doing.
Well, thank you very much, Barbara and Bob. In a moment, Mick Keane and Mike Devereaux are going to take the stage without a formal pause. But before they do, please join me in thanking Barbara and Bob.
Thanks for having me, Kevin.
Yes, you did
Very good.
Thanks. Great job.
Well, thank you. My name is Michael Keane. I'm a Deputy Director in the Fiscal Affairs Department at the IMF, and it's my pleasure and honor to moderate this last session where we take a a kind of perspective on U.S. corporate tax reform from a perspective of the wider world. And Bob's already done a very terrific, eloquent job of making the point that what happens in the U.S. makes a great deal of difference in the rest of the world. You can certainly, I think, argue that the the whole BEPS, the G20 OECD BEPS project has largely been a response, if not explicitly, but implicitly, to some of the problems that we've been talking about today. So we're going to take a look at U.S. corporate issues in this from a wider perspective, and I'm delighted to welcome Mike Devereux to launch us into this discussion. So Mike is Professor of Business Taxation at the University of Oxford, also Director of the Centre for Business Taxation at Side Business School in Oxford, and as I'm sure all of you know, is one of the world's leading academics focused on corporate tax issues. He's advised what we learnt today, the New Zealand government, European Commission, World Bank, even a low point in his career, even the IMF, he's been an advisor to. So over to you, Mike. Thank you.
Okay, thank you very much. Thank you to everybody for inviting me. It's been a stimulating morning so far. We'll try and keep it going for a few more minutes. So I was asked to talk about the view from beyond the US. And in the light of how everybody else started, I think we should have some disclaimers here. Unlike Ed, I didn't get any comments from the IMF saying I shouldn't say that I'm from the IMF, but I'm not. Just to make that clear, neither am I speaking for anybody else. What had really troubled me was that, saying the view from beyond the US. There's about 7 billion people out there who might have a view on this. I can't claim to represent any of them other than myself. So if anybody's watching on the web and I don't reflect your views, then I do apologise. So these are my views, I think. Although I think I try and put it into context a bit about the kind of the way that people talk about the US system. So I thought I'd kind of talk about two things to start off with, how people in the rest of the world, in Europe in particular, and probably the UK in particular within Europe, think of the existing system, where it's been going, and then actually talk about potential reforms, but in particular the blueprint that Barbara Angus was just talking about. So that's the plan. So I think and Bob has already said this much more eloquently than I could really. So there are slides here. I realise I'm kind of sitting in your way, so I hope you can see them behind me. So there's a common perception that the US goes out of its way to help US multinationals not pay any tax anywhere else, and the things like check the box provisions and so on, are ways in which it aims to do that. I think this is certainly a commonly held view. I think a lot of the work that went on in BEPS was responding to those kind of views. And the OECD thinks there's a problem of what they call double non-taxation, or what anybody else might call no taxation. So what and the way that it works is the US multinationals are active around the world, but they can, as Bob said, you can pay royalties to a tax haven. You get tax relief when you pay the royalty from, normally from the country in which you're paying the royalty. The tax haven is a tax haven, so you're unlikely to be paying much tax there. In principle, that money will be taxed when it comes back to the US. In practice, I imagine multinationals are waiting for another tax holiday, and so that they can bring it back at a relatively low rate of tax. That's certainly how it's perceived, I think. There are questions, I think, that now we're into effectively the implementation process of the BEPS project. We in the UK are busy introducing some elements of the BEPS project. I think there's certainly question marks in the UK and elsewhere about how far that's going to go within the US. And Bob would again know much more about that than I would do. There are issues there that there's been quite a big dispute about Apple and Ireland. And the European Commission's view in trying to take that as a state aid issue. So the state aid issue from the European perspective would be that Ireland has given preferential treatment to Apple, and therefore it's a competition issue. It's not a tax issue. I'm presenting the European Commission's view here. So if it's the case that the Irish government has given preferential treatment to a particular company, then that may fall foul of state aid rules. Now, the way in which the Commission is interpreting the tax provisions to make that is somewhat questionable. I would say it's now subject to appeal. the Irish government is going to court to try and not collect 14 billion euros from Apple, which is quite an interesting political judgment. But with respect to the US, so the US Treasury released a paper basically complaining about this whole process and saying it's unfair, we're picking on American companies and so on. So I thought, as a view from outside the US, I thought I'd better report that the rest of the world may think that's a pretty aggressive attitude from the US to complain about the European Commission trying to implement competitive processes within the EU. However, some caveats to this. That was kind of what I think other people think. This is some caveats of kind of my own, really, with respect to that. It's not really clear why double non-taxation is a problem to start off with. If you have a US multinational that's operating in the UK, is making profits, the UK system says, if you pay a royalty to whoever owns, the intellectual property you're using, you get tax relief in the UK. Fine. So what? So what happens then if it's taxed? It may be taxed in the US. It may not be taxed in a tax haven. It's all certainly complying with the UK tax system. So it's not clear to me why anybody in the UK or anybody else should necessarily complain or even worry about the fact that it may have been not be taxed anywhere else. Second point would be actually, as Bob said, and suggested maybe a bad thing, but it is certainly up to those countries elsewhere in the world to do something about it. If they don't like the fact that the royalty is not being taxed anywhere else, then don't give relief for it, and that's up to them. That could be some kind of minimum tax, but it's not exactly saying it's all the fault of the US, although that's certainly how it's kind of presented many times. And so some of the empirical work we've been doing in the Centre for Business Taxation is we have access to tax returns in the UK. So these are these are corporation tax returns. We have this is the population of corporation tax returns. Some of those tax returns are from affiliates of foreign multinational companies, and some of those are affiliates of American multinational companies. This is kind of very preliminary evidence, but the preliminary evidence we find is actually it is true that affiliates of foreign multinationals in the UK tend to pay considerably less tax than comparable domestic companies. So that's kind of that's consistent with multinationals being able to shift profits around. What we didn't actually find was that there's a particular problem of US multinationals compared with multinationals from anywhere else. So German multinationals pay as little tax as US multinationals do, but they're all paying quite a lot less than UK domestic firms. So I guess the way that one looks at this really kind of depends on where you start. It's certainly the case, as we believe, and I think everybody else has said, multinationals manage to arrange their affairs so they don't pay that much tax, certainly on international activity. And to some extent, that is, enabled by some of the US tax rules for multinational companies. How one responds to that, I think, depends on where you start looking. I think the other element of the US tax system, which people take note of, is the US is not a competitive place as a location for actually doing your business because of all the other things that everybody else is saying. It's got a high tax rate, tries to tax worldwide income. Because I think Ed said it doesn't tax worldwide income because of deferral. So, in principle, there's a tax on worldwide income. On the other hand, the fact that there has been at least one tax holiday on when dividends are repatriated to the US means that that induces multinationals to leave their profits abroad, as we know. So there's huge amounts of profits not coming back to the US and not being taxed in the US. So in a sense, there's kind of the worst of all worlds here. You've got high tax rate, and if you really did want to come to the US and do your activity rather than go to Canada or Mexico, then you'd be subject to a high US tax rate. If you wanted to incorporate in the US and do business elsewhere, then you'd be stuck with paying the US tax on repatriations back to the US. And even if you're a foreign owner of that company. So if I, as a UK citizen, wanted to set up a UK company to do business in Australia, then I'd be taxed in the US on that money coming back, and I'll come back to that in a bit. So on the face of it, that's not a good idea. It would be stupid for me to try and set up a US company in between me and the UK and my business in Australia. And therefore, the incentive is not to be an American company. That's why the US needs anti-inversion rules. But this is like kind of saying, what are we doing with anti-inversion rules? We're saying, okay, there's a lot of companies here which are already US companies. We're going to kind of lock the door, kind of bolt it several times, and every time they kind of think of a way of unbolting it, we're going to put some new bolts in. What are we doing there? Well, we're taxing old capital. We're taxing the profits of companies that are already profitable in the UK. And any well-advised new company which is trying to set up in the future, then the next Google or the next Facebook would be well advised not to set up a US company in the first place, and then they wouldn't have these anti-inversion problems. So that's a common view as well. So my take on that is this view justified? Then actually, yes, I think it probably is. I think there are kind of issues with several elements of that tax system. I mean, one which I have greatest respect for Ed and Thornton as well in kind of thinking about how we should kind of redesign and refocus the US tax system. But I kind of do worry about trying to tax worldwide income just on the basis of you've got your headquarters or your parent company in the US. And there's some interesting statistics here which come from Steve Rosenthal and Lydia Austin from the Tax Policy Center. So, and actually the share of corporate stock owned by US individuals in personal taxable accounts, and on their accounts, it was 85% back in the mid-60s, but now it's about a quarter, it's 24%. And 26% of US corporate stock is owned by non-residents. The rest is owned in tax-preferred accounts like retirement accounts. So actually, if we think, we're having a worldwide system because, we've got a personal income tax system which taxes worldwide income. We need a corporate tax system to, back up that personal income tax, and therefore that needs to be on worldwide income as well. I think, these statistics kind of cast doubt on that idea, I think. Incidentally, in the UK, it's much worse, if you like. 54% of UK stock is owned by non-residents, and only 12% is actually owned by taxable people in the UK. But this is a trend. My prediction would be the US is moving in this direction. It's continuing to move down, and the further we're trying to kind of tax worldwide income in the US, the more these statistics are going to go against that, I think. Why else might we want to do it? There's an argument for capital export neutrality. We don't want to kind of distort where US companies do their business, and if there's a kind of bottom line of US tax wherever you go, then that would be a good thing. Of course, under the existing system, that's hardly working though. I mean, we think US companies are paying much less tax on their outbound investment than they are on their domestic investment. So, we're a long, long way away from capital export neutrality. I think Ed would argue, this is good for combating tax avoidance, and that's true conditional on being a US company. I think my concerns are much more to do with we're placing an awful lot of pressure on kind of US residence rules here, if that's the basis for for the tax system. Okay, so those are comments on the existing system, really. So this is kind of mostly about tax reform, so I thought I'd say something about that, and in particular about the blueprint, the proposal by the Ways and Means Committee. And essentially, as several other people have already talked about, it's essentially a destination-based cash flow tax. Now, this is something that I personally have actually been working on for quite a long time, it's like about 15 years or so. So I'm delighted to see that it's come out of the ivory tower, and actually other people are talking about it as well. Well, I said proposed, it's been proposed by an Oxford group. This was somebody else who called it an Oxford group, but there's been a group of lawyers and economists that I've been chairing over the last 2 or 3 years, which has been trying to think about, how should we think about international tax reform? And this is one of the things that we've thought about quite a lot. So I should say that Mick is one of the members of that group. The other economist is Alan Auerbach, and we have 4 lawyers who are Michael Gratz, Paul Oosterhuis, Wolfgang Schön from Germany, and John Vella from the UK. So that's the group. So I thought I would go, into a little bit more detail than Barbara just did about, what the, I think I'm allowed to say what I like about this. I'm not really constrained by politics. So let me say something about what I think are the benefits of this. I think this is a kind of very interesting idea. So the cash flow tax, we've talked about that a lot. I mean, the basic idea would be we replace depreciation provisions with immediate expensing. there are issues about what we do with financial sides. Our proposal within our group, I think, would be primarily just to tax real flows rather than financial flows. There's what the Mead Committee called the R base as opposed to the R plus F base, the real plus financial. But in order to kind of have some tax on financial companies, our proposal, I think, it would say we need to tax financial companies on their transactions with non-taxable entities. So actually, if you try and tax banks and other taxable entities, US businesses on their financial flows, they all net out anyway, really. So a tax on just real flows rather than financial flows for most of the economy would work fine. We'd need to supplement that, I think, with a tax on banks just for their transactions with individuals primarily or other tax-exempt entities. So that's what it would be. Why cash flow taxation? Well, this is something that economists have advocated for 30 or 40 years or possibly even longer. The idea is that it, as has come earlier in the discussion, it falls on economic rent but not the normal return to capital. So, it shouldn't discourage the scale of investment, it shouldn't discourage investment conditional on the location at least. It would be neutral between debt and equity finance. There's some simplicity there. We don't need to therefore keep track of the difference between debt and equity finance, and neither do we need to keep track of the value of assets as under depreciation provisions. So those are the kind of cash flow elements. The much kind of more radical element, though, is really the destination-based idea, which is it's in the blueprint. So the idea of this is very much along the lines of VAT. VAT is generally levied on a destination base. It may be that you're not all quite as familiar with VAT as everybody else in the rest of the world, but everybody else in the rest of the world has got one pretty much. So how does it work? And basically what we propose, or what would be proposed under this, is the place of destination is essentially the place where you make a sale. Now there's kind of lots of technical issues about exactly what we mean by that, but that's the basic idea. If you have a kind of US producer that kind of sells a good to me in the UK, then that income is generated in the UK and would be taxed in the UK. That's the place of sale. Now, why is that an interesting idea? Why might that be a good idea? Well, because actually the tax is being levied in the place where the consumer is, and we're thinking about third parties here. So, third-party consumers are generally not going to move there, where they are in order to help their, suppliers save some tax. So, and we're thinking primarily about individuals, so that's a kind of relatively immobile tax base. It's going to be very difficult to start shifting profits away. How do you implement that? You can implement that the border adjustment bits, just like VAT. We say if you have a US producer selling abroad, that export is not subject to tax in the US. So exports are zero rated. However, conversely, we will tax imports coming into the US. The difference between this proposal and VAT is really the treatment of labour costs. So VAT is a tax on value added. That's equivalent to tax on economic profit and on the return to labour, so wages and salaries. What this tax would do would be to give relief for those labour costs. So it's just a tax on the economic rent, just a tax on the economic profit. And under such a system, you can ignore foreign activities. I think Barbara described it as a kind of territorial tax, but it's not really a territorial tax in the normal sense that people think of it. I think of that as being it's a tax on activity taking place in the US, and we're not going to be worried about activities taking place elsewhere. This is a destination tax, which is completely different. This is a very radical change from existing systems. One aspect of that is when we're thinking about imports by US businesses, suppose this is implemented in the US, then there's two offsetting effects. One is because it's an import into the US, it should be subject to US tax. On the other hand, if it's imported by US business, then, and that's an input into that US business's activities, it's a cost to the business, so that cost to the business would be deductible in the normal way like all other costs. So those two elements of the tax would net out exactly. So there's a tax on the import, there's relief for the cost of the import, those two net out to zero. So certainly in many cases, a simplifying aspect of that is we wouldn't actually need to keep track of imports either. So we would neither tax them, nor would we give relief. And thinking of it in that way, you can actually see why this has a lot of nice properties with respect to profit shifting. So basically, we're saying intercompany transactions are just not in the tax base at all. So all the kind of transfer pricing stuff that we kind of worry about at the moment are basically going to not be in the tax base. So if a US company sells to an affiliate abroad, that's an export, that's not going to be part of the US tax base. If that affiliate sells something to the US parent, as I've just said, that's not going to be in the tax base either. So there's no point in manipulating prices because it's not going to affect your tax position in the US. And if other countries did it, it wouldn't affect their tax position either. The capabilities of profit shifting are very much lower within this kind of destination-based tax. So one other thing we could think about is, for example, royalty payments. Suppose it's the other way around, that there's a company with intellectual property in the UK, and there's a company in the US which is making use of that intellectual property and paying a royalty to the UK. Now, under the existing system, broadly that royalty would be tax deductible in the US and would be taxed in the UK. Under this system, it wouldn't be. That use of that intellectual property in the US is like an import into the US, if you like. So it should be taxable. On the other hand, it's tax deductible because there's a cost to the US. So we'd just ignore that royalty payment altogether. So again, many of the ways in which profit is shifted to tax havens just kind of drop out of this system. In principle, it's neutral with respect to relocation decisions as well. That's kind of mainly because you're being taxed where your consumer is. You're not going to be taxed where you do your production, and so actually it's neutral with respect to production decisions as well. There's kind of more to say there if anybody wants to challenge me on that, but let me kind of move on. And primarily because of incentives with respect to profit shifting, there's kind of whole swathes of the tax system we can just get rid of. We're not going to distinguish between debt and equity. We don't really need to worry about transfer pricing rules, think-out rules, CFC rules, because all the things which is those rules are trying to guard against just wouldn't be relevant within this system. So let's just kind of think briefly about the tax system properties, but I'm conscious of the title I was given, which is the kind of view from the outside world or the rest of the world. So I really want to think about this in the context of, well, suppose the US did this, how would the rest of the world think about this, or what would be the impact on the rest of the world as well? The first thing to say is what we've done is to take the existing tax system, by these border adjustments of zero rating exports and taxing imports. We're basically saying, look, there's no tax on domestic source activity. If you produce in the US and sell somewhere else, then you're not going to be taxed on that income because that's zero rated exports. Only the location of purchases matters. So what is that doing? If we think about I think you put up a slide right at the beginning of the way that corporation tax rates have fallen over time. Now, corporation tax rates have fallen over time because there's been a very strong process of tax competition as governments compete both for real activity and for profits. What would this be doing? This is like a kind of leapfrogging, dramatic move in the tax competition game. It's saying, okay, we're going from a tax rate of 35% on your activity in the US to 0. And actually, it doesn't matter what the tax rate in the US is on the destination-based side, because actually it's not a tax on the source-based activity anyway. So the tax on the source-based activity is 0. That's extraordinarily dramatic move in the tax competition game. I know that the US hasn't reduced its tax rate for a very long time, but this would be a pretty dramatic response to what everybody else has done over the last 30 years. This seems to stop working, but there we go. So let's think about this. So suppose the US does this, but nobody else does it. How's that going to affect US companies and companies in the rest of the world? So US companies importing to the US, take a company in the UK which wants to sell into the US. UK's still got a conventional corporation tax, so it'll pay tax on its, on its conventional source-based system in the UK. When it gets to the US, there's going to be tax on the import as well. So that's pretty bad news for people producing elsewhere and exporting to the US. What about the other way around? Companies exporting from the US are not going to pay tax in the US because they're exporting and it's going to be zero rated. Actually, they're not going to pay tax in the place to which they're exporting either, because they've got a conventional source-based tax, at least a corporation tax. They may have a VAT. So initially at least, the US is going to be, an extraordinarily attractive place to do your business and do your production. You wouldn't want to be anywhere else in exporting to the US, neither would you, but you would want to be in the US exporting elsewhere. So that's got to be good for American activity. What's going to happen, now let's go back to what other governments are going to think. Well, they're going to be furious, frankly. The US has just reduced its tax rate from 35% to 0. So, okay, you're going to have to deal with that. And, Bob's going to have to go back to the OECD and explain it to them. So that's not the easiest task, probably. But actually, suppose the US actually did do this. How are the other governments going to respond? Well, the obvious response is to do likewise. Actually, if you can't beat them, you join them. So, the UK, the best response from the UK would say we have to move to a destination-based system as well. And if they did, then they would no longer be taxing UK companies which wanted to export to the US. And they would be taxing US companies which wanted to export to the UK. So, the UK would then start to collect some tax revenue again. And they would then take away the kind of disadvantage to UK companies relative to US companies. And I guess all other countries would be in a similar kind of position. So an important thing here is really, and one that we thought about a lot within our group, this is kind of self-reinforcing incentives for adoption. So, when we've normally thought about international tax reform, and we all go to Paris and kind of sit around a big table, or Bob does, I kind of look from afar, and everybody's got to try and agree on something. But governments are, inherently they face this trade-off. And on the one hand, it's a good thing to agree and coordinate at the OECD or elsewhere and come up with rules to prevent tax avoidance. On the other hand, those governments are competing with each other and they're reducing their tax rates. My country, the UK, has been particularly adept at doing both of those things. On the one hand, it's played an active role in the BEPS process of the OECD. On the other hand, when they finish that, they go back to London and they kind of invent ways of competing with everybody else. We've reduced our tax rate from 28% to 17% over the last 5 or 6 years. Of course, at the same time, we've introduced the diverted profits tax because we're kind of a bit confused about which direction we should be going in. So on the one hand, we do want to kind of collect some tax revenue. On the other hand, we want to compete. So that's kind of, we do that because we have a source-based system. We want to attract real activity and some revenue. This system, in principle at least, when you write down the nice economic theory, it all kind of seems to be incentive compatible. This is a good thing. If you have this kind of thing, other people want to join you. Other people want to have a destination-based tax as well. And so, we think the DBCFT exhibits incentive compatibility in the sense that, if other countries have got it, you probably want to have one as well. And then there's no particular reason to undermine that system by reducing a tax rate. The tax rate is more or less irrelevant then within this system. And as evidence from that, I'd say, look, we don't observe competition in VAT rates around the world. We do observe competition in corporation tax rates. Why don't we observe competition in VAT rates? Because it's on a destination basis. It's where consumers are, and there's not much they can do about it. Finally, just a final note on one of its properties. This is, in principle, at least, a highly progressive tax for the reasons I think have come up already. This is a tax on, effectively, it's a tax on consumption from sources other than wage income. And it's other than wage income because we're giving tax relief for wages. It's a tax on economic profit in a particular country. And, has been mentioned, that's going to be highly progressive. There are innumerable implementation issues, so I just kind of listed some of here, how are we going to deal with financial services. The problem of losses has been mentioned. If you're kind of producing in the US and exporting all of your products to the rest of the world, then you're going to have a taxable loss in the US, even though you're profitable overall. We have to figure out how to deal with that. There are issues of source-based rents, which we could talk about. That is, there are cases where there are clear rents or profits available on a source basis. The most obvious of those is the kind of natural resource. If you have a diamond mine in your country, you probably want to tax some of the returns from that independently of this tax system, which is only going to be based on destination. There are the WTO issues which came up already, and there's how do we tax imports by domestic consumers, which is a kind of problem with VAT at the moment. But if I'm sitting in the UK and I download something from Amazon, and then in principle the UK wants to collect VAT on that, now it would have to collect DBCFT on it as well. So those are all kind of big and complex implementation issues, which we can talk about more if anybody would like to. Otherwise, I'll just conclude. Viewed from the perspective of afar, I think, and it's quite interesting. When I come to the US and I come to Washington, D.C., I'm always kind of pleasantly surprised by how much people are willing to talk about fundamental tax reform. Now, actually, if I go to London and talk about this, they all kind of wave me back to my ivory tower in Oxford and say, look, this is never going to happen. If I go to the OECD, they say the same thing. Actually, when I come to Washington, people are quite interested in talking about this stuff. Problem is that actually when I come to Washington, D.C., it's the kind of place where actually nothing ever happens in terms of actual tax reform. So maybe things are different now, perhaps. So I think the existing US system has lots of problems which everybody has been talking about, but this is at least an interesting option for further exploration. I'll stop there.
Thanks very much, Mike. Okay. Well, maybe I can just ask a couple of questions before throwing it open. I guess one is kind of, in a way, following up on the point that you made about the equivalence between destination-based cash flow tax and a VAT combined with a kind of wage subsidy, as Kevin was saying. So are there kind of any economic or legal merits in going through something called a destination-based cash flow rather than saying, let's get rid of the corporate tax, have a VAT, cut wage taxes? And in a way, on your incentive compatibility point, is that in a way already what a bunch of countries are doing? Not in Europe, they're trying to move from the VAT, move from labour taxes to the VAT. I don't know.
The big picture, I think, is exactly that, actually. I mean, if you look at what's happening around the world, there's competition on corporation tax rates. Governments need some money from somewhere, and where they're going, they go to a tax that they can raise some money on, which is VAT. So why are they doing that? Because of these kind of extraordinarily powerful economic forces. This is happening anyway, I think I want to claim. Corporation tax rates are going down, VAT rates are going up kind of everywhere outside the US, I think. And that's because of those powerful economic forces. Yeah. Now you can just kind of leave that to go, and I think ultimately we will get to the same kind of position where we're relying much more on VAT and much less on corporation tax. Right. Or you could say, okay, well, let's kind of observe that's happening. Let's actually think hard about how to put that in place. And I think then you're right. Then there's two ways of doing it. You could think of it as a corporation tax where we're going to make these adjustments of the kind which I've talked about, but we're still going to call it a corporation tax. Or you could, what's economically equivalent would be to say, as I said, this is like VAT and a subsidy to labour, if you like, because a VAT would tax economic profit and it would tax labour. Yeah. So if you introduce a VAT, then but you only want to tax the profit bit, you have to reduce taxes on labour. Economically, I think they're the same. Legally, the WTO thing comes up. We know that a VAT is perfectly okay with respect to WTO rules. Cutting your payroll tax is also okay with respect to WTO rules. So, we economists get somewhat puzzled about, why the WTO may say, okay, you can have a VAT and a payroll tax subsidy, but you can't have a destination-based cash flow tax, which is economically equivalent. But, who am I to argue with that? I'm only an economist.
Right. Me too. We all share that. One other thought I wanted to run past you was a lot of the discussion we've had today seems to be about the idea we want to tax rents, basically.
Yeah.
And at least one difference between some of these proposals is where we do it, kind of who gets to tax the rents. So you mentioned some rents we probably think have some kind of location kind of tied to them, like natural resources. So we kind of maybe want to allocate those there. I know, and I guess another approach to kind of the other rents is a kind of phrase that is a dirty word in Paris, but we're allowed to say it here, which is formula apportionment. So we have the CCCTB proposal in Commission. As you know, we've thought about it a bit on the group, the idea that says, well, okay, as Ed's saying, these multinationals have these global rents. So how can we allocate those? Why don't we, in the longer term, think of allocating those rents across countries by some formula? Maybe take out some bits of profits we can allocate by more or less standard arm's length pricing, spread out the rest between countries in by some formula. Which in a way you could say, well, one view of the future is your vision of the VAT rising and labour taxes going down. Another one is to say, well, suppose we carry on the path of the world. Suppose we carry on the path of the world becoming more like a big federal country. We know all federal countries have formula apportionment of some sort. Maybe that's where we're going to end up. So maybe you can say a bit about thinking on the kind of more formulary-based aspects of approaches.
Yes, I think that's several questions in one.
Well,
but
it was.
Let me,
I think it was one incoherent question.
Okay. Well, let's kind of think about formula apportionment first. I mean, that's so. I mean, a lot of these proposals are all trying to kind of deal with the kind of same problems, and it's a perfectly reasonable way of thinking about how to do that. There are kind of different ways that one might do that. I think the CCCTB proposal is to say, like other formula apportionment systems, multinationals within Europe would work out their European-wide profit. So you don't need to say whether you made it France or Germany, Italy anyway, it's just you make this in the EU. Then we allocate it to individual member states on the basis of some formula. The EU proposal is a kind of classic three-factor formula. And then each individual member state gets to tax out of their own tax rate. So that's the kind of basic idea. That clearly solves a lot of problems. It solves most of the transfer pricing problems, at least within the EU, although not between the EU and the rest of the world. It doesn't kind of deal in the same way as the kind of destination-based cash flow tax does in terms of kind of neutralities, but except to the extent to which, it depends what goes into the formula. So on the one hand, if you say we want to have some kind of element of source-based tax, then you'd want to have some element of the source base into the formula. So you might have, the number of employees or capital employed in the formula. But the extent to which you do that, then you've still got some kind of competition problems, and you're still going to have distortion to where real activity takes place. The extent to which you say, actually, the only thing we're going to put into the formula, as I understand, is more and more the case in the US states, is sales. Then you get back to something much more like the destination-based cash flow tax, but on a kind of slightly different basis. It's not quite the same, and there are kind of different issues of implementation, I think. Right. So, as you know, we've kind of thought about two proposals within our group in some detail. One is the destination-based cash flow tax. One is what we call the residual profit allocation. The idea within that is to kind of borrow a bit from formula apportionment. So in that sense, that proposal would say, okay, we will allocate some tax revenue to the place where production takes place, a source country. We'll do that by using rules which are okay within the transfer pricing system, which is basically a kind of cost markup. So we identify costs that you have in the US, say. We could allow them a markup that would give you some kind of level of profit in the US where you're actually doing your production. Then we work out the residual profit on top of that. So if we kind of work out that kind of residual profit all over the world, and then take that away from your total profit, the rest is a kind of residual profit, that you can then allocate that residual profit on a formula apportionment basis. And one way of doing that would be by sales again. That too has kind of quite a lot of nice properties. It's kind of intended to try and get around many of the transfer pricing problems that we have at the moment. So there are certainly other ways that you could think about that.
Right. Thanks so much. Well, let me open it up, see if there are questions or comments from Mike. Why don't we go to David at the back?
David Wentworth, IMF. So what are the opportunities for gaming this system, since tax lawyers and even tax economists are pretty good at always figuring out a way to get around it?
Well, it's quite hard to come up with them, actually. So, some of the people we've got in our group, their professional lives have been devoted to gaming tax systems.
That's why they don't like it, right?
And actually, in the course of the discussion, they've come up with things. So, for example, when we're talking about, should we apply this on a real basis, or R plus basis, or an R plus F basis? They didn't like the R plus F basis on the grounds that actually nobody would pay any tax, because the companies, effectively the way it would work, if companies could kind of deposit their profits in a bank account, that would be tax deductible and they wouldn't pay any tax. So we have tried to think quite a lot about this within our group. Beyond that, they mentioned anything so far, and they've been kind of quite hard pressed to come up with things. So it's not obvious how you do it. And similarly with VAT, if you ask the question, how do you get around VAT? Well, there's kind of at the margin, there may be carousel fraud, but those kind of things which, then that's a kind of question of the kind of design of the implementation where you're really getting down to the specifics of how it's done. But I don't think there are any obvious ways you can game it.
Mm-hmm. Sorry, Kevin. Yeah.
It's actually a question for both of you. Could you kind of layer in exchange rates into the discussion a little bit?
Oh.
Sorry.
Do you want to say something more than me?
You want more on this, me.
Okay. Well, okay. There's a question which kind of is sometimes posed. Suppose we think of a US company which is producing here and selling abroad. We're giving tax relief here on the kind of labour costs, but we're not taxing that income. They're going to have a taxable loss, and if it's a kind of neutral system, we actually have to give relief for that loss. So, and you might actually think, well, if you've got a high US tax rate, you're going to get more relief for that loss, and therefore, this would be a higher tax rate would be a good place to come. So the reason why that's not true is actually we expect changes in prices. So, one way of thinking about that, even with a fixed exchange rate, suppose that world price of let's think first of all, a small open economy, the world price is fixed. When you're kind of selling that good into a small open economy which has a destination-based cash flow tax, that's going to push the higher the tax rate, that's going to push up prices. So in equilibrium, what we'd expect is that prices would go up, prices of outputs would go up, but also the price of labour would go up because we're only taxing economic rent. If we're thinking about labour. If we're thinking of VAT, then the price of labour wouldn't change, but in this case, the price of labour would go up. So basically, we'd expect the price of labour to go up. That's going to offset this kind of tax relief, which is why the net effect in terms of kind of neutrality of where investment will take place is that it would be neutral. So we do expect, so those kind of price effects we would expect to happen. They happen much more easily through an exchange rate effect because, if there's a fixed exchange rate, you really do have to have kind of nominal changes in wage rates. That would take, some time to filter through. With a flexible exchange rate, it can happen more or less overnight with just changes in the exchange rates.
Sorry, Eric, I think you had a...
Thank you. As you know, capital income is taxed at both the firm level and the individual level, and there are provisions in the House blueprint. But I was just wondering how you envisage capital gains, dividends, and interest of individuals being taxed under this plan.
Right. So we've tried to focus just on the kind of international side of corporate tax and basically leave that to one side. So we're not really proposing any changes to kind of personal income taxes, mainly on the grounds that, we don't want to kind of design a whole tax system. We just want to focus on the corporate tax. I don't think the destination-based tax kind of makes things any worse than the existing system. I mean, it is true that there was, the problems of, how you're going to tax capital gains, how you're going to tax dividends and so on. There are problems there which would continue to be problematic with respect to kind of personal taxes. But I don't think they become any worse. But we're not really proposing, on the other hand, we're not really proposing any ways of, of relieving all of those. One could go to other systems, which would are more focused on those.
Mm-hmm. Please.
Thank you. My name is Li Yang. Thanks for your presentation. You have a lot of good points. But I think in the system, whether it's in the United States or overseas, there's a biggest problem, and I think probably now President-elect maybe have a problem too, when people reminded him about the problem about Department of Justice, then he'll back up or about what he thinks should fix the corruption. So for tax system, because a lot of things is not because people don't pay tax, but because abuse, not just a collection agency like IRS or Comptroller Office, but by the phony attorney or phony accountant, they abuse our proposed legislation, or even there's no such a legislation, they abuse something, make up phony stories. So I just wonder, currently, is there any effort to propose such fixing the system in such a manner to fix the abuse or corruption? Really do the things like if you have task force in Ways and Means committee, if you have task force to cooperate to fix the system, really fix the system, so in such a way, so people, they can have assets or equipment, or they can have time or resources to enjoy family life. This will be a super plus in our effort to fix the system, plus we have a lot of revenue left.
Well, I think our proposal is not going to help here. Well, I mean, there may be other things in the blueprint. I mean, but you're talking about tax evasion of kind of individuals and businesses within the US. If people are going to evade taxes, they're probably going to evade the destination-based cash flow tax as well. There's no.
I'm talking less about individual invasion.
Yeah.
I'm talking more abuse by other parties, like third party or IRS.
Okay, I think I have the same answer. I'm afraid I'm not going to solve that. Certainly, the proposals I'm talking about here are not going to solve that.
I thought it solved everything. Those proposals.
Oh, actually, that's true, right? Apart from that,
just one question that came up briefly. I think Barbara mentioned it's on your slides. Could you say a bit about losses? The plan to deal with losses, because there can be permanently profitable firms and permanent big loss makers.
Yeah. So this is clearly an issue because as you say, you could be a profitable firm but have taxable losses in the US, and they could be permanent.
Yeah.
So just carrying forward the loss is not going to solve that problem because you can carry it forward and just get bigger and bigger, but you can never offset it. You even never have any income in the US to offset it. On the other hand, if you'd say, okay, well, that's tough, you're not getting any relief for losses, then actually the kind of properties that you claim for the system of neutrality and efficiency don't hold either.
Right.
So in order for this to work, that problem has to be addressed. The kind of things that we've thought of for doing that are really mostly along the lines of, it relates to the VAT and payroll tax idea. So, if you have a taxable, suppose you think of it as suppose it was implemented as a VAT and a payroll tax. Then the problem would kind of disappear because the VAT payroll tax element would be we introduce a VAT and we reduce payroll taxes. So what would happen? There would be no loss on the VAT side, but you've given up all these payroll taxes, so there's a kind of net negative effect on US tax revenue. If we did it as a corporation tax, you would have a taxable loss within the corporation tax system because actually that kind of reduction in payroll taxes effectively is your taxable loss. So one way that you could deal with that is to say actually, well, that you could offset that taxable loss against other taxes that the company is paying, like payroll taxes, and that would kind of be equivalent. That would be more equivalent even to VAT and a payroll tax.
Yeah.
But there's certainly an issue that something that you'd have to have rules permitting that kind of thing to happen.
Okay. Is there any more questions? No more questions, comments? Well, then it falls to me to close the day to thank AEI and Kevin for hosting this fabulous event, and my colleagues for helping organize it, to Mike and to all the speakers. So join me, please, in thanking you.